We are in the first session of the program. The program has been structured into 6 comprehensive sessions. Today, we will be learning about the building blocks of options, the advanced concepts of options, before we jump into various strategies in tomorrow's sessions. A disclaimer before we start. So request everyone to honor the privacy agreement. We will return back your favor in rich dividends in the subsequent sessions. So we strongly believe that nobody owns knowledge. Okay, everything has been learned from various sources. So you can use this knowledge and apply it however you want, wherever you want. Absolutely fine. We only request for the rights on our content, which includes our PPTs, our videos, and the document that we would have created, nothing else. All right. Thank you so much. And even we have got updates from people that, this student of yours is teaching this particular topic. That is fine, because even I have learned from hundreds of trainers. When I am teaching, why can't others teach? Anybody can teach, never a problem. Only point is the content has to be respected. I hope I'm very sensible in this request. All right, so let's move on. So here is the options program agenda. The day one, we will talk about introduction to options trading, additional options literature, and the directional trading strategies. Tomorrow, we will get into some unique concepts like inter-index strategies, non-directional trading setup, and Thursday expiry day strategies. Okay, and that's the agenda for today and tomorrow. So now let's start with options. Friends, those of you who are already experts in options, who knows options pretty well, you guys have to bear with me for this session. Okay, because this session would be very basics for those who don't know options, because in a program there can be people of all kinds. So it's our duty to ensure everybody is on a common page so that they understand. All right, so let's move on. Friends, what are futures? Why? What is the primary purpose of futures? Does anyone understand what is the purpose of futures? Why someone needs futures? Many people trade cash market, many people trade futures market, options market. Why do you need futures? What is the purpose of futures? Theoretically, it's a contract. Yes, future is a contract. When does the futures expire? Most of the futures and options expire on the last Thursday of the month. Nowadays, since with the arrival of weekly contracts, every week we have lot of contracts expiring. It is an agreement between a buyer and seller, ideally, so that they make a transaction at a predetermined price. That's what is future. But what is the primary application of futures? Okay, you are all traders, you trade in F&O, you trade cash, that is fine. I am a businessman. How does futures help a businessman? Anybody? Did anyone think about it? How does futures benefit business? Leverage? No. Hedging? No. Yeah, hedging is okay. Small investment against future, more profit, premium. So many words. Now, friends, how many of you know this company, Graphite India Limited? I am sure many of you would know, because its stock grew almost 10 times in the last year, right? By the way, this company was just next to my previous software company. I used to work for a company called SAP. I was heading their product management in the supply chain domain. Very next building attached to the IT complex was this Graphite India, very dusty factory with lot of dust here and there, old buildings. I never thought this bloody company would make such a fortune. Okay, all because of the China factor. Now, Graphite India as an organization, the biggest raw material is crude oil. Now, I'm going to explain you what is the primary purpose of futures, how companies use futures for their benefit. Now, let us say the finished product of Graphite India is, say, cost is some X value. Now, the cost of raw material, suppose the biggest raw material used is crude oil, and let's assume, okay, because I don't know the finished goods manufacturing process of Graphite India. I'm just taking a ballpark example. Let's say 30% of the raw material is crude oil. I repeat, not 30% of raw material, 30% of the value of the manufactured product. If the product cost is 100 rupees, 30 rupees, maybe manufacturing cost is 50, but 30 is the cost of crude, for example. Okay. Now, let us assume that Graphite India is a company which is operating at 20% operating margin. Okay. So we have a product whose raw material is crude oil, and that comprises of 30% of the manufacturing cost. This company is operating at 20% operating margin. Now, for some reason, if crude oil price doubles, let's say crude oil price goes up by 50%, what will happen to the company which was having 20% margin? Think and answer me, please. When the raw material crude goes up by 50%, there is a loss of 10%. No, I think there is a profit margin comes down big time. It will drop to around 5% roughly. Why? 30% was the initial raw material crude oil cost. If it's 50% up, it becomes almost 45%, right? Roughly. Yeah. So what happens? A company which was operating at 20% margin, it loses another 15% of the profit margin because of the rise in raw material. So what if it doubles? You have seen crude almost touching $150. Imagine how many companies would have gone bankrupt. Correct? Everyone agree? Understand? Give me a check. Because of this problem, fundamentally, companies go for futures. What is the future? Today, I am Graphite India. I will speak to a crude oil manufacturer and tell him, sir, today crude price is, say, $50. Okay. I will pay you, say, $55 for the same crude you can deliver me after 1 year. The manufacturer thinks, okay, this guy wants to buy crude today only, commit today for next year, no problem. Let me strike a deal. So he signs an agreement with him to deliver crude next year at just 10% premium. So $50 is the cost of crude. He will commit 55, which is roughly about 10% premium. It doesn't matter for him. Now, what happened to him? What actually happened right now? So Graphite India safeguarded its risk. So what did they exchange? They primarily physically exchanged an agreement, but tangibly they exchange risk. How many of you understand? Graphite India pushed their risk to the crude oil guy. Correct? How many of you agree? I am signing a contract right now that next year you need to deliver this particular product to me at this price, period. Now, what if price falls? What if price falls? Even if price falls big time, even if price falls big time, but Graphite India as a company will not go into losses. Yes, that is a risk management. Graphite will tell themselves it is our risk management process. It is our insurance. How many of you paid car insurance and started repenting, oh God, my car never met with an accident, damn, I missed the insurance? Does anyone think like that? No, right? We are happy we are not met with, we don't get into an accident to so as to claim an insurance. Same thing with Graphite. Graphite is not worried. Now, who is benefited when price falls? The seller is crude oil guy, oil company is benefited. Who is benefited if price goes up big time? The buyer is benefited. Excellent. So ultimately what has happened, there is an agreement between two parties on a predetermined price on a predetermined date. Correct? What is your future? Same thing, no? Future expiry is 3 months from now. Futures price is so much. Majority of the times your future price is more than your spot price. Very rarely, because of this dividend adjustment and things like that, many times spot price would be slightly bigger. Okay, that is the fundamental purpose of a future. Everyone got it? But we as traders use that as a financial instrument. We will trade that commodity. I'll come back to you on those aspects. Now, hope everyone got the underlying principle. Is that clear? Step 2. Now, what is an option? The future is something where Graphite India speaks to oil company, says, okay, December 2020, this is the price I am going to give to you crude oil, and you have to deliver me at this price. Agreed. Both parties agreed. The Graphite is happy that their risk is mitigated. Oil guy is happy he got a business. He got a transaction done. He will manage his profit somehow. Now, options is an agreement. It is another unique agreement where the buyer will have an obligation. Okay, will not have any obligation, but the seller will have an obligation. For example, if you look at it in futures, right, if the price falls, the seller, the oil company, is benefited. If the price goes up, Graphite India is benefited. Correct? Even if price goes up, all of you agree that the seller has to sell the component to Graphite at the same price committed. Everyone agree? Second, if the price falls down big time, then even Graphite India has to honor the commitment. They have to buy at the premium they committed. Yes or no? That equal right is called as a future. In case of an option, Graphite India, instead of committing an agreement of that sort, it will get into an option agreement. What it will do, it will not commit to buy. What it will do, it will pay a premium. It is like a token advance. Okay, I'll give an example for an option. Okay, now think about, just read the statement once. If you buy or own a stock option contract, it gives you right but not the obligation, okay, to buy or sell shares at a set price at a given date. After this date, the contract expires and option cease to exist. That is a theoretical example. To understand option, let me give you an example. Right, you're in Mumbai, I will not take Mumbai as example because Mumbai is very costly. I will preferably take Bangalore. In one of the decent locations of Bangalore, there is a property available, an apartment, 3-bedroom apartment available at say 1 crore rupees. You like the apartment, you want to buy it. You go to the builder, you pay him say 2 lakhs token advance or maybe 5 lakhs token advance. What is the token advance? You pay 5 lakhs and tell the building owner that, sir, here is the advance. I will come back and buy your property after 3 months, after 6 months, once my loan is approved by the bank and I do get my property registered. All right. So after 3 months, of course, you got your loan, but suddenly you realize there is COVID-19, because of which there is a huge state of uncertainty. You decided not to buy. What will happen to your token advance? Will the builder return it? The builder will return it and you will lose. Would you cry for losing the token advance? Let us say the property rates dropped 25%. You will praise God that, oh, thank you, I didn't get into an agreement earlier, or else I would have bought it at a premium. No problem, I will wait now and buy the property at a much lower price. Is it not? But imagine the property price went up because of excellent economic conditions, and the property value from 1 crore it becomes 1.25 crores. Now when this guy goes to the builder after 3 months, the builder has to sell the property at 1.25 crores. He cannot say, sorry, I committed 1 crore, I will not give you one, now pay me 1.25. Can he say that? No. The builder has the obligation. The builder has to deliver, but the buyer doesn't have any obligation. Is that clear? That is an option. That is a fundamental difference between a future and an option. In case of a future, there is an equal obligation. In case of an option, there is a one-sided obligation. Buyer is always benefited. And buyer doesn't care losing that money. Everyone agree? We'll move ahead. The primary purpose of an option is to hedge the risk. Correct? Even in Graphite, the purpose was to hedge risk, not to trade. Okay, everyone thinks options are for trading, futures are for trading. No. Good. So here is a car example that we spoke. We buy an insurance. The car is the asset. The insurance is the option. Okay. So we buy an insurance. Same thing. You pay money. If the car meets with an accident, you go to the insurance company and claim the insurance benefits. Okay. If there is no accident, you don't go to the insurance company and you don't crib about premium lost. That's it. Now tell me something. What did you do with the insurance company? Don't you think you offloaded your risk? You are offloaded your uncertainty to the insurance company? Correct? You are selling your risk. You are selling your risk by buying an insurance. You are selling your risk by buying an option. Very nice. But don't forget that insurance costs money. Correct? Every year you have to pay a premium, maybe 2% of the value of the car. Remember, friends, one out of the box knowledge to every one of you. Every individual should have health insurance. Majority of these fellows who are working professionals always think my company gives me insurance. That is rubbish. Well established MNCs gives good insurance. Normal companies don't give. For your kind information, last year I took an insurance from this health insurance called Star Alliance Insurance. I went for them only because my wife's uncle and aunt are doctors. They own a hospital in Bangalore, and that hospital has instant claim from that Star Insurance. So I went for it. You know what I did? I took 40 lakhs insurance for my family, health insurance. You might ask me, what nonsense? Why should someone buy an insurance of 40 lakhs? I will explain you. I paid an X amount for insurance of 10 lakhs. The insurance guy said, sir, if you pay some 25% more, I paid roughly around 30,000. Okay. I paid roughly around 30,000 for it. If you buy for 10 lakhs, it's around 20 plus. If you buy 30 plus, whole family, each individual, all four of you, wife and 2 kids will get 10 lakhs minimum independent. As a whole family, you get 40 lakhs insurance. I said, wow. And what is additional 6-7,000? 500 rupees per month. Not even 10 rupees per day, hardly a coffee. I blindly went with it. The moment I bought that insurance, after 2 days, the insurance guy walks into my office along with his general manager sales. He said, sir, we love your approach. We love your thinking. We want you to be our partner. I said, what partner? No, we want you to promote our products and services. You can be a reseller and all. I said, sir, I don't have time for all that. I don't know why you guys chose me for all this. He said, sir, out of 1,000 people, hardly few, handful go for this model. You are one of them who blindly went for it. I said, it is peanut. I paid you peanut for a huge gain. Touch wood, there should not be any situation for that scenario to consume. But what is that money? I hardly pay 6,000, guys. 10 years, it's 60,000. 60,000 to safeguard in every possible angle is nothing. And I told, see, I thought in these lines, I like the concept, and I went for you guys only because my favorite hospital has alliance with you, nothing more. And I'm not interested in this product because I don't have time to sell your products and services. Don't mind. Uh, Hardly anyone buys it. Why? I think no. What would happen when COVID came? Recently, I read in newspaper that an individual cost would be around 3.5 lakhs INR. Okay, for all the foreigners here, 1 lakh is like 100K. Okay, 3.5 lakh is as good as the cost is around $5,000. Okay, but think about it. Anything can happen. You never know. But if it is affordable, we should not hesitate. And many people even curse me. I have a life insurance, which is a term insurance. It cuts around 4,000 every month. Okay, and it is a 2 crores insurance, and I don't even realize. Now it has become a part and parcel of my life. Every month the credit card cuts 4,000 rupees, but it is 2 crores insurance, which is inflation adjusted, which means every 5 years, 10 years, that becomes 3 crores and 4 crores and so on. It's a term plan. It's absolutely a term plan. Okay, so I'm sorry, we went out of the box, but friends, recognize this fact. All of us should respect risk, and destiny can be cruel. We need to face it blindly, confidently. Now coming back, traders. Okay, we are the notorious guys who want to use every asset in the world in a way we want. They use options to speculate. Any one of you who are buying options to mitigate your risk? You are not mitigating your risk. You are increasing your risk by trading options, correct? Okay, none of us trade for mitigation. Now, Kohli is playing cricket. Wow. All of us watch cricket. So what is the purpose of cricket? Entertainment. Cricket is a business. It is an entertainment industry. Sports is also an entertainment industry. But there are people who do betting. There are people who will bet on a match. There are people who bet on a team. There are people who bet on an individual ball. This ball can be a 4. This can be a 6. This can be out. Okay. And is it the fault of cricket because people do betting on cricket? Whose fault it is? Similarly, futures and options are meant for a primary purpose and they are respectfully filling their and doing their duty. But we as traders, we are using them as a speculation tool and we blame them. Great. Next, strike prices. Friends, the stock price, okay, generally, when you go to the NSE website, whatever is the price that the stock closed yesterday, we call it as a spot price. Okay. Why? That is the price at which the official shares are transacted. That is in cash market. Okay. Now, coming to futures, if you look at it, there is something called as a futures price. Definitely the futures price would be comparatively higher. Why? If I am buying Infosys at 1,000 rupees today, if I want to go in an agreement with somebody else, I might have to buy a little more for future, right? Because of the time value of money. Now, what is a strike price? Imagine a betting where India has scored 250 runs in 40 overs with five wickets in hand. I repeat, 250 runs in 40 overs with 5 wickets in hand. I will throw a betting saying India, I guess, easily can score 350. Why? There are 10 overs to go, 5 wickets in hand, 2 prime players are playing in the best of the form. So 60 balls, 100 runs with 5 wickets possible. So I'm telling 350 is possible. That is a strike price. Everyone get that? That is a strike price. Now, in cricket, the price can always, the score can always go up. If the team has scored 250 in 40 overs, they cannot go to 200 after 40 overs, right? It's impossible. The runs can never come down. But in price, the price can come down in future. Everyone agree? Either the price goes up or price comes down. Now you can throw a betting that, okay, 1 year down the line, Infosys price can drop 30%, or 1 year down the line, Infosys price can go up 30%. Both are possible, and that number is called as a strike price. The strike price is a price at which the stock will be exchanged or exercised at a predetermined time. Can everyone give me a check if you agree with me? Vikram says one more time. Vikram, simple. Today, Infosys price is 950 rupees. Okay. I will say, okay, by next year, Infosys price will become 1500 because I am bullish. And there's one more guy who hates Infosys for various reasons. He says, no, I don't think Infosys would grow. Infosys would be roughly 750 rupees after 1 year. And both these prices are strike prices. That is the price at which a prospective betting is done. Spot price means the current market price. If you want to buy one share of Infosys, you need to pay the yesterday's closing price. In simple words, if I go to NSE website, I type in fee, Infosys price yesterday close is 708. Okay, and official close is 705.55. This is because they will take the last 30 minutes average as the complete closing price. Okay, now if I click on the derivative quote, the future of Infosys expiring 25th June is the expiry for this month. Why 25th June is the last Thursday? It is the last Thursday of the month. It's hardly 5 days to go. That is why the close price is just 1 rupee above, maybe 0.5 to 1 rupee. Think about it. I change it to 30th July. Can everyone see? From 706, the price went to 707. I'll change the time to 27th August. It went to 707.55. So if you go away because of time value, there shall be a slight increase in the price. Now coming back to our demo. The next thing is expiry day. Every contract expires. How many times you get a message, sir, your insurance is expiring, please renew your insurance. Sir, your emission certificate of your vehicle is expiring, please renew it. Agree, everyone? You have to, most agreements expire on a particular day. So in stock markets, it is the last Thursday of every month. What does that mean? Which means that month contract expires and a new contract gets opened up. If you want, you need to renew the contract and move ahead. For example, suppose you are buying a future and you are carrying the future for the month of June. So 25th of June, the June month future contract will expire. So what you should do, you should sell it before the 25th of June and buy July month future if you want. And that process is called as rollover. The general expiry of any stock is last Thursday of every month. Bank Nifty expires Thursday of every week. Nifty also started weekly option. So Nifty, Bank Nifty, they die every week. The contract expires every week. Only stocks every month. Expiry means the current month or current week option contract is coming to an end and a new contract agreement will come into existence. And that whole process is called as rollover. How many of you understand rollover cost money? Everyone agree? Rollover cost big money actually. What would be the annual cost of rollover of futures? Anybody? Any thought? The total annual cost perfect. Dinker says 6%. Absolutely correct. Okay, on an average 0.5% is the cost of rollover every month. So suppose instead of buying 1000 shares of Reliance, if you are buying Reliance one future lot. For example, what is a future lot of Reliance? I type Reliance Industries. I will check there. The spot is 1763. Derivative code is 1765. And one lot is 505. Okay. So if you buy in 505 stocks in cash, if you hold 1 year Reliance, there would be some profit. Now, if you buy one lot of Reliance future, your total cost of future rollover would be at least 6%, because every month you need to roll over to next contract. You don't have that problem in cash. Why? In cash market, you are buying an asset. In future, you are buying only a contract. In cash market, it is like buying a property, registering a property. It belongs to you. How many of you own property? How many of you own houses, plots? You don't renew them, no? You just pay the corporation tax, that's it. But you don't renew your registration agreement every year. It is a permanent contract. Sagarika says, Ashok, many times we see a huge difference in spot and future price, either in premium or in discount. See, significant amount of time spot and future, there would be a gap. The future would be always higher. That is because of time value. So whenever the future is cheaper than the spot, there can be many reasons. Number one is dividend. Whenever they announce dividend, this will get adjusted. Okay, and sometimes, rarely, there will be genuine arbitrage, but as a manual trader you can never capture it. If I even tried to build an algo to capture it, I could not win. My colleague Pradeep is still working on that concept. We could not succeed. Okay. All right. If Thursday is the expiry, suppose Thursday is a holiday, okay, then Wednesday is your expiry date. So Prakash says, Ashok, if future is small, lesser than cash, does it indicate weakness? No, you cannot conclude like that. Types of options. We have only two types of options: call option and put option. Friends, let me tell you, in the initial days of my learning career, I used to connect to mnemonics. I used to always confuse between call and put. So I made this. When I call somebody, which means I take something, okay, which I want to buy. It's like buying. When I put, I throw, which means I don't want it. When will you pick a share? You call a share when you think the share will go up. You put a share when you think the price will drop. Correct? Everyone agree? You call a share when you think the price will go up. You put a share when you think it will drop down. That is the kind of connection I established. So which means a call option is an option which you buy when you want, when you think the price goes up. Put option is an option you buy when you think the price will go down. This is how I relate it, to remember the nomenclature. Okay, if the price goes up, I will call the option. Okay, if the price is if I think the price goes down, I will put the option. I will put it. I don't want it. I will call when the if I think price goes up. I will put when I think price goes down. What is a call option? Again, call option is an option where if you buy a call option, you have no obligation. Okay, you bought an insurance, you are the buyer of the insurance. You pay a premium, which is the premium of the option price, and you are done with it. Okay, if it gives you profit, you are happy. If you don't, you don't care. And your maximum loss is whatever is the option premium you have paid. You will buy a call option when you think the price is going up. And you will buy a put option. Okay, you will buy a put option when you think that a price is going down. Since it's always buying an option so far, which means you don't have to worry. Now tell me something. What is the difference between option buyers and option sellers? Friends, all option buyers are those guys who buys insurance. All option sellers are like insurance companies. Everyone agree to that? All option sellers are like insurance companies. Think about it. Imagine the situation of all the insurance companies because of COVID. If people claim insurance, what would be the situation? What would be the situation in case of a major accident, a fatal fire, and so on? Okay, so insurance selling has its own challenges, its own risk. So any one of you goes into option selling, you are doing at your own risk. You will have serious obligations. Okay, you might panic. Okay, recently in one of the groups, one of the participant of the previous group, in one of the old edition group, the one man started expressing extreme displeasure towards me. Okay, and he was making some nasty comment in the group. I just went and, you know, what can I say, disable his chat and deleted his message and buzzed him personally, and he started fighting with me. He started abusing all trainers are same, starting from that man, this man. I said, sir, what is your problem? What happened? Okay, he was not controllable. Okay, that is why I disabled. And this man did not understand the concept of disabling a chat. He thought he has been blocked. Okay, and he started firing more. Then I explained him and later realized, okay, his problem was we taught him a strategy, called inter-index strategy, which we will teach tomorrow. What this man has done, he has not followed the rules. He cut one of the legs and whole position became naked. We were very, very clear. Okay, he didn't even follow 1% of the rule book. In a place where he would incur 2,500, he landed up in 35,000 loss. Okay, before I could even calm down, I said, boss, hell with you, take your money, get out. I don't want your money also. It's almost 6 months since the program over. You can't come and yap at me like this. I'm throwing your money, give me your account, my team will settle your money, goodbye. And then he says, I made. So I said, I don't care if you have lost 35K or 35 lakhs. You should at least give an opportunity. You need to discuss, you need to debate. And then he says, sorry, I was all fault. I went through the whole video. I didn't follow one step. I kept left and right. He sells wherever he wants. He buys option. He sells a big option lot. I mean, it was not at all a strategy what he was doing. I said, how can you do this? Said, yeah, I did all this on that day. I was so upset. He's a 50+ old man, and he started. Then I said, take your choice. I'm sorry, I cannot take all these blamings. We don't belong to that category. If you want, feel free to walk out. We'll take care. Okay, then he said, no, Ashok, I'm sorry. I'm sorry. I don't know. I was in a wrong phase of mind. And finally, I had a call with him. He apologized. I said, you don't have to apologize because you're senior to me. But these are all the scenarios which everyone face, and rule is a rule. If you don't follow a rule, I am not at fault. Okay, when I tell, when you learn swimming, jump in a 6-foot pool. Okay, don't dive, go into the water with protection, with vehicle tubes. You style, go and dive in a ocean. I'm sorry, yaar. You need to be very careful, friends. Anything with options, reason I'm telling is selling options are dangerous. Okay, You need to be very cautious. You need to understand. When you first test the water, think like business. How many of you, if you set up a business, will you start one small branch or you will directly open 100 branches? Why the hell you trade 10 lots? Why not start with one lot? When one lot is successful, go to two. When two is successful, go to three. I will not even say doubling every time. There's no hurry. People, before they even finish first semester or first year of medicine, they want to do open heart surgery. Doesn't work. Friends, if you fail, you have to blame yourself. If you win, take full credit. Same thing holds good with every damn trader. Don't blame your people, your family, your ex-boss, your trainer, your investor, nobody. This is a beautiful business where you are sole responsibility. There is no way you can throw the blame on others. Correct? Cool. So very clear options, right to buy. Okay, call option, the buyer has right to buy. In case of put option, the buyer has right to sell. Okay, that is the whole process in a nutshell. Remember, the buyer is the insurance buyer, car owner. The seller is the insurance company. An option usually contains the following. Correct? The option buyer, there is an option seller, the insurance buyer and the insurance company. It has a strike price. What is strike price? The price at which we are taking a decision that okay, Infosys is 1,000 rupees today, it will be 1,500 tomorrow. That is the strike price. Time frame, there is an expiry date. Every contract has an expiry date beyond which the contract ceases, before which you need to square off. If you don't square off your position before the expiry date, what will happen? Friends, if you don't square off a contract before the expiry date, what would happen? What will happen to your contract? What will happen to your trade? The trade would be auto squared off by your broker. Correct? The broker will square off everything on behalf of you. He is not liable to even answer you. 3:15 on the last Thursday expiry day, he will square off everything. And finally, price. Everything has a price. Okay, I'll throw why price premium changes. Friends, have you ever thought why premium changes? In simple words, take the same cricket example. India is at 250 runs in 40 overs, 5 wickets to go. Now, what is the probability of India scoring 300? Can somebody type in percentage? 100%, 80%, whatever. 70%. Narsimha says, okay, what is the probability of India scoring 350? 100 runs in 60 balls. 50%. Okay, what is the probability of India scoring 400? 25%. Oh, too much. You're quite greedy. Okay, those of you who type 25%, next time whenever India does 250 times in 250 times, I'm sorry, 250 runs in 40 overs, just buzz me, okay? I will take your bet. 1:4 RR. If I lose, I pay. If I lose, I'll give you 100. I'll give you 1 lakh. If you lose, just pay me 25,000. Is that fair, Paresh? Dinker, you are the guys who said 25%. Okay, whenever it happens, blindly I will buy. I don't care. Even if you win, I don't care, because statistically I know I will only win in long run. So that is the point. If the probability of a scenario happening is more, then you pay more premium. If the probability of a scenario happening is very less, you pay very less premium. Okay, what is the probability of India achieving 500? I'm going to pay 1:100. Every time you win, I'll give you 100, 1 lakh. Whenever you lose, just pay me 1000 rupees. How many of you wanna bet? Pay me just 1000 rupees. Whenever I win, whenever you win, I'll pay you 1 lakh. Nobody is paying. But however, there are so many people who go and buy an option, an OTM option, which costs nothing, and dream about a profit. So option is all about probability. Now, let me tell you very important thing. In case of future, you will lose money only on one scenario. What is that? We need to know this part. Very, very important. In case of futures, friends, in case of future, you bought here. Either price can go up or price can be there only, or price can come down. Okay, now if price come down, you made a loss. When price goes up, you made money. When price stays there, you are neutral. You are neither loss nor gain. But in case of an option, option is a crazy scenario. You know why? I'll show you what all scenarios comes there. This is your level. Okay, this is your expiry date. Now, now what happens? Your price in case of a expiry, okay? Now imagine if it goes up, it's good. But by that time, you have something called as a strike price. I'm sorry. You have something called as a strike price. Now, if your price by any chance closes here, what will you get in case of option? You get nothing. Because what was your betting? You said you are betting India will score 350. If India scores 349 also, you will not get your money back, correct? Does that guy agree pro rata? If you bet India would score 350 and by any chance the match India achieved say 340, you think your seller, your betting guy will give you money? Oh, poor chap, just missed 10 runs only. Let me, it's okay. I will spare you. But in case of future, he will gain at 340 also. Whatever money he got, he gained. In option, it's not only about price, it's also about time. It's a price and time confluence. Even if you don't achieve the price at the stipulated time, even if price don't comes within that time, if the time doesn't within the price, it is zero. So there are many things here. What are they? If it goes sideways, you get nothing. If it goes down, you get nothing. It goes up and doesn't touch the price, you get nothing. Okay, there are many permutation combinations in case of options. You need to be crystal clear. All right, now when I ask every one of you, will you bet India scoring 500? Nobody is ready. But how many of you took OTM options, dreaming that someday price will come in? So Vikram sir, more than option futures, absolutely. Futures are straightforward. Futures are straightforward. So when will option traders make money? The call option guys make money when price goes up. Okay, the call option sellers will make money when price goes down. Correct, no? If you are the buyer of the insurance, there is a seller of the insurance, right? So when price goes up, when you buy call option, you make money, but whoever sold you that option, that insurance company, will lose money. In case of when price goes down, a buyer, you are the buyer, you make money. If it goes up, the seller will make money. In all standards, when you tell yourself, okay, who is seller? Seller is insurance company. So tell yourself, am I qualified to be an insurance company? I'm capable. Only you should sell. If you should naked sell without an hedge. This is what happened to our colleague from the previous batch. Okay, I mean, when I explained, these are the 4 simple rules. I don't see anything there. What did you do? He said, I took a trade. After that, I didn't bother left and right. I kept on selling, buying, selling, buying. I didn't even realize. By the time I realized the total loss, I found 35,000 MTM loss. Around 30,000. I always keep telling traders should not be like monkeys. You know, like software engineers jumping companies every 2 years. Okay. So we used to even have many colleagues who used to not even complete 1 year in office. Every 6 months, 1 year, they jump. Why? No appraisal, no hike. Go to next company, take hike. Go to next company, take hike. How long you will sustain? After 5-6 jumps, world will know that you are fit. You have not achieved anything in your life apart from taking salary hikes. But in trading, you need to be a donkey. You need to follow the process. Stick to the rule book. Sometimes it will test your patience. Sometimes Sachin has gone for a duck 2 times, 3 times. Sachin has gone continuously 10 matches bonkers, but he was never ever, okay, a man without class. I always say form is temporary, class is permanent. The class comes only with process. Yesterday also I saw many trades, wrong trades which worked, right trades which failed. But I always tell you, if you stick to right trades, let it fail, eventually you win. But a wrong trade winning is an illusion. Everyone get that? Okay, now friends, simple, one question. If price is going up, there are only 2 ways to make money. Which are they? When price is going up, I can buy a call option or I can sell a put option. Correct? How? Can you make out this? I can buy a call option. I can sell a put option. Okay, let's say price is going down. Who makes money? The guy who buys a put and sells a call. What does it mean? When price is going down, the insurance guy will make money, the insurance buyer will make money, and the call insurance seller will make money. So going long on a call is similar to shorting a put. It is not similar. It is technically not similar. In case of buying a call, you have limited loss. In case of shorting a put, you have unlimited loss. Why? In case of a call, you are an insurance buyer. In case of a shorting, you are an insurance seller. Why? If that guy's car meets with an accident, you need to pay the cost. Okay, now let me ask you a simple question. There are millions of cars in this country. Everybody, most of them will have a car insurance. You think insurance company is losing money? Never, never. Why? According to the theory of averages, they will never lose money. Okay, because statistically majority of the cars don't meet with an accident. So shall I say that most of the times option writers makes money? The number of option writers, if you keep on one side, and all the option buyers, when I say option writers, option sellers, okay, who will make always money? The sellers will make money. The fact is, when you sell is the key. You think insurance company will give you all classes? How many classes insurance company will keep? You should not be diabetic, you should not be above 50 years old, you should not be an heart patient, you should not be HIV positive, act of God. How many classes they add to fight you? Similarly, as a retail trader, if you want to sell an option, if you want to sell your insurance, you need to have a very clear rule book. You need to know when to sell, when to buy. So when you sell an insurance, think like an insurance company. Put all your classes, put your processes in place. Don't just go and say, hey dude, I'll sell, come take whatever you want. Don't depend on the mercy of destiny, depend upon the mercy of your hard work. Okay, perfect. So very clear, a buyer will have limited risk, unlimited profit, correct? You pay 15,000 car insurance, even if the cost of vehicle is cost of repair is 1.5 lakhs, you'll get that. But what about seller? Limited profit, he got only 15,000 from you. But if your vehicle goes to an accident zone, he will have to pay you a lot of money as claims. So 90% of options expire worthless. Option sellers most of the times make money. Who is the richest insurance company in India? LIC. How many of you know LIC can move markets? How many of you know LIC can move markets? You know, whenever central government goes for elections, whenever they want positivity, whenever they want to move the market, they will tell LIC to buy. Do you all know? LIC has a very clear instruction not to short markets. How many of you know this? LIC has the biggest stake in some of the biggest multinational companies in India. LIC rarely shorts market. If you ask me personally, they don't have the authority to short market because their bosses, who is the government, doesn't allow. So there are three kinds of prices. Okay, now take the same cricket example. There are three kinds of prices, friends. One is in the money, one is at the money, one is out of the money. Okay, take the same example of cricket. Okay, in case of cricket, we spoke about 40 overs, 250 runs, and 10 over and 5 wickets to spare. The 250 runs which have been achieved as of now is called as at the money, which is nothing but the current price. Everyone agree? The 350 we targeted is called out of the money, because that is an amount that has not been reached. That is called out of the money. And what about 200 runs? What about 150? Things which are already been achieved, that is called as in the money, which is inside the scoreboard. That number has already entered inside the scoreboard. If you want to replicate it in cricketing terms, at the scoreboard, outside the scoreboard, inside the scoreboard. Sensible? Now, in case of options, the price not only can go up, it can go down also. Correct? It's not like scoreboard. Okay. Now think about the call option. What is call? Call is similar to your scoreboard. The scoreboard keeps going up. Call option also keeps going up, whereas put option keeps going down. Now let's say the current price of Infosys is 1,000 rupees. Now 1,000 rupees is what? It is at the money call, correct? Current price. Okay. Now if I expect Infosys to go maybe 1,200, what will that become? The 1,200 call, if the current price of Infosys is 1,000, it is called as out of the money, because that is a value it has not yet achieved. Everyone clear? And in case of a call option where price should eventually go up, the 800 rupees call, which has already been achieved when the price is going, when you're counting upside, that 800 rupees is already achieved, no? Because we are 1,000 rupees now. So 800 score has already been achieved. So that is in the money. Everyone clear? So when you are buying an option, okay, what is the probability of Infosys retaining 1,000 rupees in next 1 week? Without going down? Very high. Now what is the probability of Infosys going 1,200, which is 20% up in next 5-6 days? That is out of the money. Now by any chance you take this betting that Infosys option, if you buy an Infosys option at 1,200, by next week of expiry, even if it touches 1,199, what will happen to your money? You will not get it, because your betting was 1,200. Only if you score above 1,200, only you will get your profits. Or else the insurance guy, the option sellers don't care about you. Now think about options. Again, current price is 1000. So the current price is nothing but always at the money. Okay. And if you are the opposite guy who is betting the price to go down, don't you think 1200 is already achieved? When you are betting downwards, price is 1000. What would be your target? If you are thinking the price will go down, your target would be what? Your target would be 800, right? In case of put option, the 800 becomes out of the money, because for a put option guy, that price has not yet been achieved. That is far away from the betting price. And 1200 becomes in the money for the put option. It is exactly opposite. In case of your scoreboard, it is as good as call option, whereas in case of put option, it is opposite, because in games your price don't come down, whereas in price it goes up and down. Okay. Now look at this. Yes, Manish. Okay. Now, whenever the strike price, the stock price is greater than strike price, we call it in the money. For example, let's take the same Infosys example. The current price of Infosys is, let's say, 1500. Let's take a different number so that we connect. Okay. Strike price is equal to 1500. Okay. Stock price is 1500. Strike price is 1500. If it is same, it is in the money. So in case of a call option, if you are looking for a higher strike, okay, then you call it out of the money. And if it is a price below your strike, your current stock price, then it is called in the money. So for a call option whose current price is 1500, anything below 1500 is in the money, anything at 5500 is at the money, and anything above 5500 is out of the money. I will show you all in an example. In case of put option, let's say Ashok Leyland is 50 rupees now. Current market is 50. Strike price is also 50. So it is at the money. Now in case of call option, anything above the stock price, it is out of the money, right? But in case of put option, anything above 50 is in the money. And in case of put option, anything below 50 is out of the money. Why is that? Because you are betting the price should go down. Can you guys have a look here? This is the simplest way. The current price, stock price is 40 rupees. The strike price is 45 and it's a call. What is it? It is out of the money. The same strike price, stock price of 40, if it is the same value, it is at the money. If the strike price is 40 and the price is lesser, it is in the money. The same thing holds good. Exactly opposite. If strike price is lesser than stock price, it is out of the money. If it is same, it is at the money. If it is higher, it is in the money. Now, I am declaring that OTM is the cheapest of all. Why? OTM is cheapest of all. Why? Why are OTM options cheaper? Ram says far away. Manish says future probability. One reasonable answer from Prakash and Amit is less probability. Thamin also. Anything that is lesser probability will command more premium, right? If I bet, okay, this over we might see a 4. This over we might see a 6. Anybody will score. If I say this over, we will see at least 4 sixers. That is a challenge. Why? It's very low probability. For such a betting, you get lot of premium. Correct? Your opponent will not pay you big money if the probability is high. The higher the probability of happening, lesser is the price. Same thing in theory. High risk, high reward, low risk, low reward. And options generally have two kinds, intrinsic value and extrinsic value. Okay. Now, let me explain in simple terms what does these guys mean. Okay. So instead of too much of gyan, I will directly go into the chart. Okay. And draw an example. Now, friends, let me take a bigger font. The current price of Tata Motors is 100 rupees. Okay. Now, I am betting Tata Motors can go to 120 in next 2 months. What is 120? It's a strike price. Okay. So what is 120 call? When current market price is 100. It is 100% OTM call. Okay. Now, what is 80 call? When current market price is 100. It is in the money. Now, what happens? The price. Okay. The current price is 20 rupees, 100 rupees, right? Now, if you look at it, so I will say the 120 call price is around, price is say 5 rupees. And 80 call price is 20 rupees. 100 call price is 102 rupees. Now, friends, please understand, in case of a call option, 100 call price is 102. Means this is 100% in 100 rupees call option. The intrinsic value is 0. Okay, let me tell the formula of intrinsic value. For call options, okay, strike price for OTM options, intrinsic value is 0 because the difference between the strike minus spot is same. Okay, in case of ATM options, there is a bit of intrinsic value. Okay, 100 rupees call is not 102, it's 2 rupees. I'm sorry. Okay, 100 rupee 120 call is 5 rupees, right? 100 rupee call, current price is 100. So 120 call, let us make it 5 rupees, and this call, let us make it say 12 rupees. Okay, now it is better. Thanks, thank you so much, Ram. Okay, now it is sensible. Thank you. So let me put it this way, that is best. This will give the better understanding. So when you go far away from the strike, if the strike price keeps increasing, price keeps dropping. Now it's sensible, no? Thank you, sorry. Okay, in case of OTM options, intrinsic value is almost 0, which means the strike price is always above the spot price. Spot price is 100, no? Which means strike price is 100, spot price is 100, 100 minus 100. Whereas in case of ATM options, okay, the strike price is 100, right? I'm sorry, OTM option, right? 120 minus 100. 120 minus 100. So you are almost 20 points away from the current price. Now, in case of ATM options, it is 100 minus 100. So officially, it is 0. In case of ITM options, there is huge intrinsic value. So 80 minus 100, that is plus 20 rupees. Okay. Now the point here is, friends, if you are taking 100 rupees as the current market price, 80 rupees is already achieved. When the price of Infosys is 100, the strike price of 80, that has already been achieved, which means the current price is 20 points ahead. The current price is 20 points ahead of the strike price. So when it is 20 points ahead of the strike price, when you bet, you are damn sure there is plus 20 rupees of value. Okay, so whenever you go, for example, let's say what would be 50 rupees call. The cost of 50 rupees call price is around 50. I can even make this 21 for that matter, to make it more robust and realistic. So 140 rupees call price maybe 3 rupees or 2 rupees. 160 call price maybe 1 rupee, and 180 call nobody to sell. Why? Nobody to not sell, nobody to buy. Is this concept clear, friends? So current market price is 100 rupees. From the value of current ATM call is this 12 rupees. Okay, this is ATM, and anything below is ITM, anything above is OTM. So OTM is getting cheaper, ITM is getting costlier because ITM has intrinsic value. Suppose in your school days you are scoring 60% every year, and your mom says you should score more. If your target is 70, that is your OTM. But 50% you already achieved, no, last year. Who would value that? You have already achieved. So your mom doesn't give any weight to that 50%. She said that you have already achieved, that value exists for you. That is called as intrinsic value. Should we draw the same thing for put option? $500 put of any of the companies, let's say $520 put, $490 put, okay. So in case of put option, if the price goes down, because the higher strike price is in the money, the lower strike price is out of the money. You go lower side, it becomes out of the money. The value becomes lesser. The best way to see this is in our site. Okay. So I'll go to NSE site. Okay. And I will go to, for example, Nifty, derivatives, Nifty. Okay. And I click on option chain. Okay. And this is the option chain of Nifty, which you see. So according to our learnings, this is the strike price of the option, the whole thing. Okay. The calls comes on left side, the puts comes on right side. The LTP of both is here. Okay. You have the bid quantity, bid price, as quantity, as price. You will get the total spread. You will have the net change. Okay. And you have something called as implied volatility. You have volume. You have change in OI, and OI we discuss in next session. Okay. Now, when I go down, please notice that Nifty price is 10,245. What is at the money? Okay. So friends, when the price of stock is 10,245, you can't have 10,245 as at the money. Okay. Generally what happens, they are round figure. Okay. In this case, then either you pick 10,250 or 10,200. Rounded number is at the money. Can you notice this beautiful thing here? See, for example, this white region. Can someone tell me what is that white region? What kind of ATM? OTM, can you confirm? I'll just mark the quadrants. Now help me to take it. This is 1, 2. I'm sorry. Let me mark it like this. Example, option. If price goes lesser, then it is OTM or In call option, it is straightforward. Higher prices or value. Now, let me throw a simple question. Now the price is 10,250. Okay. Now let's say price, rounded price is 10,250. Can you give me a check if you can hear me? Okay, thank you. Okay. 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 Now look at this example. Okay, now 10,250 is our ATM. Now, what is LTP? Here it is 164 rupees. How much of this is time value when you think about 10,200 as strike price? So 50 rupees is intrinsic, right? Because if you're looking at a strike of ATM of 10,250, for 10,200, that 50 is already achieved. So anything more than 50 is your time value. So out of this 164, you remove 50. How much is time value? 114. Now let me take 10,000. Okay, strike price is 10. The ATM is 10,250. For an ITM call of 10,000, what is the intrinsic value and what is the time value? You have 306. The intrinsic value is 250. Remove the 250 from that. Exactly. 56 is time value and 250 is intrinsic value. Now I'll go further. Okay, I will take 9,750 call. 523. Now tell me how much is intrinsic, how much is time value? It is 500 points below our price. So 23 rupees. Can you notice that every time you go behind, your intrinsic value is dropping? I'm sorry, your time value is dropping. Okay, so because the time value drops, why? Because the probability of achieving it is very, very high. So time value is always like that. Anyway, so what is the risk in buying options? Time decay. You remember in the previous chart I mentioned, though your target was 350, if you achieve 340 also, your better will not pay you a penny. You will lose everything. It's not like in futures. In futures, if the price don't go up or down, you will not lose money. Yeah, you just don't make money. That is fine. But in this case, it is different. Okay, next, you need a big move for your target to be achieved. And you cannot be wrong, not only on time, but also on price. If your price comes before your time, you lose money. If your time comes before your price also, you will lose money. I need to draw it for you. So this is the target. This is the target price. Okay, you have to score 350 points. This is the time. Now, there are two cases here. Case 1, price goes up, down, up, down. At the time of expiry, it closed at 340. So what is the status? Complete loss. Why? You didn't achieve the target given. Now, case 2. So what happened? You achieved the target, but it came after your time. So contract expired here. So still it is a loss. So you need to achieve your price within the specified time. Everyone understand? So that is the challenge in options. That is the biggest challenge in options. And the probability of losing is 75%. Why? Because in case of buying options, if the price goes down, you lose money. If the price goes side, you lose money. And if the price which achieves your target after the time also, you lose money. So all three probabilities you lose money. The only probability you make money is when price achieves your target well within the time. How many of you got it, friends? Price goes up, you make money within the time. So price goes down, loss. Price goes side, loss. Price goes up after the time, that is also loss. So technically you will make money only in one scenario. 3 other scenarios you will lose money. In futures you have only 2. Price goes up, profit. Price comes down, loss. That's it. But here there are 4 scenarios. In out of 4, only one scenario you make money. If price goes up before time, you are in good profit. That's the first scenario. Good. So what is the risk of selling options? You know the risk of buying option. What's the risk? Your profit is capped. You are the insurance company. One corona came, one tsunami came, one earthquake, one fire. Insurance company is doomed. If you don't follow rules, you will have unlimited loss. Boring concepts. Okay? Writing is a boring concept. You need to write and wait. But what are the benefits of selling options? If the price goes sideways, you make money. Why? You will have time premium. And this helps in non-directional trading. We will talk about non-directional trading strategies tomorrow. So Urjil says if Infosys call for 1000 could reach 1050 on Wednesday and 975 on Thursday, you would make loss. Correct. You're right. You're right, Urjil. You will be in loss. Absolutely correct. They are income oriented models. In case of selling options, you can be wrong and still make money. This is the same case of what Urjil says. Urjil is telling, I have an Infosys call of 1000 rupees. Okay. And Wednesday it touched 1050, but Thursday it came down to 975. It's gone. The exercising is on expiry date. At that time, it is loss. So if your seller was losing money till Wednesday, on Thursday at the time of expiry, he made money. You were wrong and still made it. Dinker says in buying, no need to wait till expiry. Never. Not only in futures, both in options also. You don't have to wait till expiry. You can, you're in profit, you can exit. It's your choice. And all the out of 4 odds in option buying, 3 were against you. You'll make money only if price goes up, and that too in stipulated time for a call option. In case of selling, all 3 odds would be in your favor. That is why most option sellers make money. But the key point is the insurance company, when selling the insurance, they put 100 clauses. They have 100 rules. Same thing with option sellers also. They should follow those rules. Coming to the summary, the option buyer has a right and no obligation as per contract. 2 kinds of options, calls and puts. Calls makes money when price goes up, option buyers, and put option buyers make money when option goes down. Option buyers always have limited risk and unlimited profits. Okay, I don't know how many of you know that we trade on European options. That's why it has a symbol of CE and CP. In the US and all, they use CA and PA. It's called American options. Okay, options will have both intrinsic and time value, and they're always divided based on ITM, ATM, and OTM options. And majority of option buyers always lose money, and remember this fact. Okay, I just did show the demo on the NSE website right now. Okay, you can see the charts also if you wish to. At the end, you have something called as chart of Nifty. You need a flash player to run it. Okay, this page itself will tell you a lot of information. Okay, they speak a lot of volume about it, but anyway, in the subsequent session we'll deep dive into the advanced concepts. Next session I would like to deep dive on OI. Okay, that is one of the most interesting concept that everybody should know. If you understand OI, it will really add up to your trading edge. Okay, so we have not spoken about any strategy or any trading so far. We just understood the very basics of it. In the subsequent sessions we will talk deeper about the other things. Tamin says earlier Indian options were American. No, Tamin, we are always European options. Okay, so no worries, you guys park your questions. In the subsequent session all these concepts will come up in multiple examples. Okay, so you will understand and it will reinforce the thought process on your head. Okay, Stalin says, why do you prefer futures compared to options? No, I can trade both. Okay, I can trade both. If you are confident of your direction, you can trade futures. You are not sure, you can trade options. Both have their own benefits and challenges. Okay, so let's take a pause right now and come back in the next session to understand more. And any more Q&A, so who are all those new contracts? They're all shorters. They're all new contracts are shorting people. New sellers are coming in. Very good. That is short build-up. Very nice. Now, think about it. When price is going up, naturally when price goes up, who are pushing the price up? The buyers are pushing the price up. Very good. But the open interest contracts are reducing. When a contract is reducing, so somebody is closing the contract, right? And if that person who is closing the contract, if the price is going up, definitely it should be the buyer who is closing the contract. It is the buyer who is closing the contract. So who is that buyer who closing the contract? It is a guy who had already shorted before, now squaring of the position. He is covering the short by buying. Try to connect. Very, very important. Price is going up, so buyers are pushing the price up. But contracts are decreasing. Why? Because an existing guy is closing down the position. So who is this person who is squaring off? So the guys who is squaring off should be a buyer who is covering his short trade. Because he's a buyer. How do you know he's a buyer? Because price is going up. Without a buyer, why would price goes up? So you are confident that when price is going up, it is a buyer only. But all you should decide is whether this buyer is a one who is taking a new buy or a person who is covering his old short position. And this is called as short covering. Okay, friends. Now, the last leg of the conversation is, think about it. Price is going down. Who is dominating? Who is pushing the price down? Sellers. So sellers are pushing the price down, but at the same time, the contracts are coming down. If contract is coming down, so somebody, old guys are squaring off the position, no? So who is that squaring off the position? It has to be a seller. Who is this guy squaring off? He is a guy who already bought. So he is unwinding the longs. This is called long unwinding. It can be a profit booking also. It can be anything. Okay. Okay. Anand is asking, Ashok, is long unwinding and long liquidation same? Yes. It's all same. Okay. Please repeat the fourth step. See, you need to ask 3 simple questions. Okay. Number 1. Who? Buyer or seller? Price is going up or down? First check. Who is pushing the price up or down? You know. Okay, that is step number 1. Step number 2, buyers or sellers. Step number 2, you need to check OI, number of contracts. Is it increasing or decreasing? If it is increasing, it is build up. Okay, if it is not increasing, it is unwinding. That's all. Very, very simple. Okay. So Sandeep says, Ashok, what is maximum and minimum OI? I will talk about it soon, sir. Kindly park the question for now. Let's finish the basics. Now, let me throw you a challenge. Everyone spoke about arrival in price action, friends. Correct? Imagine an arrival. Imagine an arrival which is a short covering or a long unwinding. How that would be? Okay, I will put it in a different perspective. Somebody is coming, price is moving because either because of extreme buying or extreme selling, that is different. If price is coming up because somebody is covering their positions, is that a fear for you? Think about it. Apply your minds. Whenever there is a short covering and long unwinding before the price enters into your zone, or don't you think it is good for you? Because that guy is squaring off his position. He is not coming to fight me, no? He is booking profits there. They're exiting. When they're exiting and price is coming up, it's good opportunity for you. It's momentum for you, loss of strength for him. Process is very, very simple. Only 3 questions. Who is controlling the price, buyer or seller? If they're buyer or seller, step 2, whether the contracts are coming down or up. Based on that, you conclude. Simple 2 rules. That will give you the 4 scenarios. Now, the rules of OI: 2% change in price, 10% change in open interest. Now, let me do some live data analysis for you. Okay, I'll go to NSE site. Okay, go to nseindia.com. Okay, I will prefer the old website. Okay, so now I'll go to products. Friends, make a note of it. Products, equity derivatives, and then historical data, daily archives. I will repeat once again. Products, equity derivatives, scroll down, historical data, and archives of daily reports. Okay, here every day NSE will publish the data, end of day data. So what you should do, go and pick Bhav copy and select the last date. Today, for today, 19th of June. Get data. I will download it. I will also go back one more day, which is 18th of June, and say get data. And then I will download it. Okay. Now I will open those 2 files. This is 19th and this is 18th. 18th and 19th. Yeah. So what did I do, friends? Okay. I just picked the previous 2 dates data and I move them into a new Excel. New book. Okay. Okay. So what I will do, I'll better take like this. I'll first take 18th data, put it in the Excel. This is 18th and this is 19th. So I pick 19th data and put it in the Excel. Okay, friends, I have 18th here and 19th here. The last 2 days of EOD data. This contains the complete end of day OI information. Okay, we have 2 days of history to compare. Now what I will do, I will put nineteenth data here, and I'll also pick 18 data and paste it here. And paste it here. I took everything in a single page. Okay. Now, for our own analysis, we will only focus on futures for our analysis for now. I will take a future index and stock, keep away the options for the analysis, and we will only focus on this month's strike price to keep the analysis simple. How many contracts? 146, correct? Everyone clear? There are 146 stocks. Okay. Now, if I go to the left, review, view, and freeze panes, I'll go to the left. Okay. Now here I need to write a formula. So this is price change. This is OI change. So what I will do, I will take the closing price of today, not today, closing price of yesterday. Okay. Minus, I will take the closing price of today, which is 19th. Correct? Divided by X2. I'll put a percentage. Okay, so in simple words, today is 20,900. Yesterday was, I need to focus on only price and Y. So this is my focus, price. Okay. This is open interest. These two and price and OI. Clear? So just to compare, 20,900 was the yesterday's price. Today's price is 21,308. So 21,300, 20,900. So which means I have to do little opposite. I2 minus X2. Okay, the price is up. No, today price has gone up, right? Yeah. Is this clear? So when I do the check, I would notice that I will hide all the other stuff for the benefit of our analysis. Hide. I'll keep this simple. hide. Okay, and I hide everything. All the unwanted stuffs I hide. Okay, friends, I guess you can make out. So today's close is 21,300. The old close is 2,900. So price has gone up. Now, the next thing is OI change. So open interest, this is old open interest, this is new open interest. So what I will do, I'll take the new open interest minus old open interest divided by old open interest, and that is okay, and give a percentage value to it. Correct. Left side value is 19th, right side value is 18th. See, 18th is close by. Is this okay, friends? This is 20th June 2020. Okay, sounds good. So for all mathematical checks, I will just drag drop here so that it doesn't do more calculations. I'm sorry, that was wrong. Drag left, drag right, and why it's not allowing only value? Okay, no worries. Now, friends, you have price change, OI change. Now, what was the first rule? What was the rule for OI analysis? I gave two rules. %10 change in OI, 2% change in price. Now let us take the first rule. Price is going up. Okay, I will do a filter now. Data. Okay, I will have to do filtering, extend the filtering for this guy also. I will do it for this guy also. I want futures and stocks. I want only June expiry. Others I don't want. Now price change, I will say number filter is greater than 2%. How many stocks out of 140? 50 stocks yesterday was greater than 2%. Now OI, I'll say numbers greater than 10%. So who are these guys? Okay, Gopi says, can you cross check again? I am fine because this is 19th price. This first one, this is 19th. Okay, this is 19th close. Don't get confused. This is 18th close. This is 19 OI. And this is 18 OI. Okay, it's perfect. So math is fine. Why price increase compared to 18, 3% up, and OI 875, 761, 15% up. Okay, I'll hide this also. I hide this also. Happy now? I'll hide this also. I'll hide this also. All right. So now let us have better clarity. Something happened. Aha. I should not have done that. Give me 1 second, please. I'll hide everything for you. Hide this. Hide this. Hide this. Hide this. Hide this. Timestamp. Hide this. Okay. Okay. I guess this is good. First is this guy. So what is this, friends? Price is going up. Y is also going up. Long build up. So these are all long build up. Rules passed. Awesome. Now I'll go and make a change in number. Price is greater. Okay. Price is going up 2%. But Y is less than minus 10%. What is this? Price is naturally going up, which means buyers are pushing the price up, but contracts are reducing. So these buyers are the ones who are squaring off. Who are they? Short covering. They are buyers. Those who sold before, now they are buying, squaring off their positions. Everyone clear so far? Okay, now I'll go and make the change in price. Price is less than 2%. And Y say is greater than 10%. What is this? Price is going down, but Y is increasing, which means people are extensively shorting. Short build up. Short build up. Okay, and finally, if Y is less than 10% and price is falling, there is no one. So now what we will do, all. So what I will do, I will remove the blanks. Is it clear? Yes, Vikram, we mentioned minus 10. Okay, 1 second. I'm sorry. Where is that? Short covering. Okay, give me 1 second. Filter less than. I said minus 2%. This is the one. Correct? Yes, it is correct. Short build up. Okay. No worries. So we will do one thing. We'll select all here. Price also we select all. So in the entire day yesterday, there are about 18 companies which gave clarity on short and long build-up. Now superimpose, if you have a price action level, okay, if you are looking forward to trade at a supply demand zone or a, I'm sorry, you know, in a demand zone or a supply zone, if you are looking forward to trade a flag limit, a FTR, a cap, a QM, a can or anything, so when you have this additional information, it will add up to your strength. It's very simple. Okay, you can do a small utility, not a big deal. I am trying to build one small Excel based utility. What we'll have to do is you need to put a small file, both download both the files, put it in a folder and generate. It should automatically generate this Excel. Something like that will build. Okay, I will build it for everyone and give it to all I3D3 students. It will be beneficial for every one of you. Okay, I'm happy to do that. So give me 1 quarter time. I'll build something for you all. Okay. Now, okay. Now there is one question from our colleague. So Anas, park that question. We will take it up. Okay. So friends, there are two kinds of things. One is everyday build-up change. For example, the build-up change from, for example, if you take an Apollo tire, okay, Apollo tire, there is a long build-up. Till yesterday, it could have been a short build-up. If you want, you can even track that also. You can definitely track that also. Okay, so any app where you get this analysis EOD, I guess I should build a beautiful app. Definitely I'll build, because this is something which can be very useful for the traders community, and it is not rocket science to build. It's a simple app. You keep warning me. Okay, sir, build an app, build an app. Once in 15 days, keep reminding me. I will try to build an app for everyone. It can be a good tool and utility for everyone. Okay, good. Now, the next important topic is call put rating analysis for trading confirmation. So friends, open interest will give a clear indication of the range of price movement before expiry. It explains where there is maximum calls and put rating at different strike prices. You as a price action trader can use this information, okay, to really make some decisions. Okay, now let me show you that part. So Nifty Trader, yeah, go to this trade website niftytrader.in and stock options chart. Okay, I'm sharing the link with every one of you. Yeah, I sent it to everyone, and I'll also host it in the chat box. Okay, now if you look at any stock for that matter, for example, Reliance Industries making a lot of noise yesterday. It went 7%, right? Reliance. So this is the, what was the closing price of Reliance? 1765. Okay, so if you look at this chart, the closing price of Reliance is here, 1765. Price is roughly here. Okay, this is LTP. Now look at it. Blue is call your OI, put is, pink is put OI. Okay, now can you see there is a big writing here, What is this level? Around 1800. Okay, around 1800. And next, there is again one more level here, one more rating here. Put rating at 1710, maybe 1700. Maximum put rating here and maximum call rating here, and there is also a much bigger put rating at 1600. So what does this signify? This signifies that 1800. What do you mean by call rating? Okay, 1800 level, more than almost 15 lakh contracts were written. Okay, now what does that mean? Why would anybody write a call option? Go back to basics. When we write a call option, when you sell a call option, what is your direction? So when you sell a call option, what is your direction? Your direction is down. Very good. Because when you buy a call option, your direction is up. When you sell, your direction is down. So, which means those people are thinking that before this expiry, Reliance cannot go beyond 1800. So what is 1800 now in terms of our price action? Is 1800 not a strong resistance? Now if you're long, suppose you're long, you're in a long trade, so what is 1800 for you now? 1800 is a great level to exit, take profit and get out. Now imagine there is a FTR short, there is a supply FTR at 1800. So what will you do now? There is a supply FTR at 1800. You can look forward to go short. Okay, you can look forward to go short, or you can buy a put, anything you can do. Now think about traders who write options. Now friends, 1600 is a level of Reliance where there is maximum put rating. What does it mean? Who will write put? You buy put when price goes down. If you are bullish, when you think price goes up, you, which means 1600 acts as a very strong support. Okay, it acts as a very strong support. And if you are finding a good demand FTR there, what you will do? If you have a cap, a demand cap, what you will do? You can look forward for a trade, and this will give you an additional confirmation on your trades. Always remember, when you try to play positional game, okay, you will have least manipulations. Okay, higher the time frame, lesser the manipulation. That is why you guys are able to pick beautiful stocks for. Okay, there are some beautiful price action levels where they look so beautiful. It comes kiss there and go up. But the same beauty you're unable to find in an intraday. Why? Because the manipulations are so high. So it takes little time for you to digest and adjust to that scenario. So this way, like Dibyakan says, we can define the prospective range. And okay, now tell me, what is this? What is the validity of this range? Now, what is the validity of this range? It is valid only till expiry. Narasimha answered it. It is valid only till the current expiry, not even next expiry. According to this guy, I don't know if he provides next month expiry. For this expiry only, this is the rule valid. Okay. Now let us pick up any other interesting stocks you have. Any guy more? Price change. Okay, yesterday anybody with a big price change 8.5%. Who is this? Bajaj Finserv. So let us see Bajaj Finserv. Yeah. So this is the price of Bajaj Finserv. Bajaj Finserv. The price is, oh God, 9% up. 5925. Okay. So let me look at 5925. So the LTP is here, 5,925. This is 6,000. Okay. Okay, this is the LTP. LTP. Now, if price is here, the first level of resistance is coming here for calls, which is 6,100 levels. And the next highest possible support. See, put rating. Everywhere put rating is increasing. Look at this. More OI, more OI, much more OI, much more OI, and much more OI. Okay. This is difficult. See, people, when maximum rating is here, okay, what does this mean? These guys are super confident that that level nobody will come. At what price they are rating? Tell me that first. 5,000. What is the amount they are earning there? Bajaj Finserv option chain. Okay, Bajaj Finserv 6,000 is roughly LTP, correct? What is 5,000? 5,000 put. What is the price? 16 rupees. What is 16 rupees? The price 17 by 5,000. 0.5%. These are the insurance guys. Who are these people? Who are these people? Who are these people? They will write it in bulk. They will write it in bulk. They will write in thousands and thousands of quantities. But they would know how to adjust. They would be super confident. Okay. Now Dibikant asks, sir, there is every day the OI keeps changing. Generally, OI don't change from a long build up to short covering or from short covering to, long unwinding. It doesn't change overnight. It will gradually change. How it will change? For example, on day 1, this much of OI you will see, day 2, this much of OI, and day 3, this much. Slowly the OI will drop. When OI will drop, your resistance is slowly weakening. That's how you should look at it. Understood, friends? All right. Sounds good. Okay. That is the whole point. Now, what all did we learn? The OI gives insight about the underlying derivative. It helps you to identify whether there is a clear long buildup or short buildup, or long unwinding or short unwinding. It can be used for price action trades for proper entries and exit points. Okay, so that will give you a clarity on what you should do. It should only be used in conjunction with a plan strategy. You just can't just go, okay, today it's short build up, I will go and short. No. Okay, that is very clear. Now you also can merge this OI data with the Nifty trader charts, where you can know where there is maximum call and put writing. Okay, merge both these aspects. When you apply this in conjunction with price action, there would definitely be a respectable value. Okay, with this we come to the end of the second round of literature session, and next session we will get into options trading practical scenarios. Okay. And there's one question by Hari is asking why the price of option decreased even the share price did not fall much. That is because of Greeks. Okay, an option price is made up of 5 Greeks. All right. It includes delta, theta, vega, gamma, and rho. Okay, so these 5 Greeks plays a role. Many times when your price, for example, the price does not move but option has dropped, it could be reduction in time value or the theta. Okay, and many other aspects. Okay, so as far as the options learnings are concerned, I'm not going to get into the micro level of Greeks because it's a complex topic. Okay, if you want me to teach you Greeks, it will take one more full day, but we will not focus on any strategy on options. Okay, so what we'll do is we will stick to the most important things, whichever Greek. For example, for us, for me only two Greeks are important. One is delta, one is theta, and one a bit of vega, which is volatility. Apart from these three, rest of things will not talk much. So that's the whole point. So Vilas is asking, how do we know whether call put is bought or written? See, generally the chart talks maximum would be writing only. There will be less of buying. Okay, and always remember when somebody has written something, there would have been somebody who would have given that to somebody. It's a transaction, right? Okay. Now Shivangi is asking, is OI a derivative of price? No. OI is not a derivative of price. OI is a count of the, you can call it as a derivative of volume, but not price. It's a unique concept. It's on contracts. Okay. So Nifty went 1.5% up. Now let me go to Nifty futures. Okay. What is the total traded value, friends? Can someone tell me in crores? It is 17,888 crores, correct? 17,887 crores. It's not 17 crores. It is 17,800 crores. Close to 18,000 crores. It is 18,000 crores, which is okay. Okay, that's in million. If you want in lakhs, it is this many lakhs. Add one more zero. Okay, Sandeep. Good. Now let me do something interesting here. I'll go to option chain. Okay. And now look at 10,200 is Nifty, right? So 10,200 is Nifty. Okay. And if I look at 10,200, see 10,500 as maximum numbers. Okay. I will do one thing. I'll go to derivative space. I will do one thing. I will show you the Nifty index options, Nifty call options, 10,200, get data. What is the traded value? 43,783. ATM Nifty is 43,000 crores. It is only one strike. How many of you remember? This is only 10,200 call. That is a volume. Now what about 10,300? $37,882. Can you guys imagine? So what is a volume that gets traded in options? A significant portion of these volumes are getting traded because of these three reasons. The cost is less, lower margin, limited risk. Everyone agree? Everybody will jump into buy an option. Everybody will jump into a car insurance without realizing that the insurance company will always make more money. Everyone agree? Retailers significantly spend on options. Significantly. They feed. When you don't have a structure, when you don't have a process, it can hit you very hard. And remember, you'll always think, okay, no big loss. The loss is limited, profit is unlimited, but your profit never comes. Why? Your profit never comes. Why? Because you're targeting India at 400. The score is 250 after 40 overs with 5 wickets in hand, and you always think India will get 400. And those guys who buy out of the money options, let me tell you something. Look at this crazy thing, 10,200, right? Let me go 10% away. What is 10,200 into 10%? 10,000 into 1.1. So 11,200. 11,200. See the volume. They're also around 1,350 crores of transaction that happened. Can you guys imagine? 5% away. 10,200 into 1.05. 10,700. 12,300 crores. $10,700 is 12,300 crores and 11,200 is 1,350 crores. These are all insurance. These are all life insurance you buy for next 5 days. What happened? What will happen to all that money? Who will eat away all that money, friends? All writers will eat away. Good. That is the whole reason. That is why options are very, very tempting instruments. They're like ice creams. They're like biryani. You want it. You desperately want it. Okay. And that too intraday. Why? Because in a single day, there are hundreds of options which scroll left and right. I don't think you guys have observed carefully. Okay. Look at this. For instance, if I take, say, for instance, 10,400 option, or let's say 10,000 option. See, look at this beauty. How many of you can see this? This is what is the next thing that tempts people. See, 45% up. Money double in 2 days. Open is 200. High is 310. Close at 299. Previous close was 210. Direct 50% profit. Everyone get that, friends? See, this is the reason why people get tempted. This is the reason why people get super excited, because options tend to grow very fast, at the same time disappear also very fast. On a single day, the number of options that doubles are very, very high, because every strike price is an exclusive contract. Okay, every strike price is an exclusive contract. It is something people have to track. Okay, this is an interesting stock of a FTR and a QM intersection. Okay, this is example of Biocon for our understanding. Okay, so so technically this is a Quasimodo it is trying to play, and then price came inside the zone and it went up. You can always question telling Ashok there is a tested zone. Yes, this is a tested zone. Okay, in fact this is all tested. Just for the demonstration purposes I took this example, so don't mind. Okay, now in case of future, what would happen? Your entry is here roughly at around 217. Your stop loss is around 211. 6 points risk. Your target is 18 points from 217, 227, 237 minus 2, 235. This is your target, which eventually achieved. Now, instead of taking this trading bet of buying a future, imagine what would happen if you had bought an option, preferably at the money option at 213.92 with around 2,214. I don't think Biocon will trade at 214 strike price. I would say officially it would be 215. Now in this scenario, look at Biocon. Okay, 215 call option because we were bullish. Okay, then when did the trade happen? The trade happened on the day of this day, which is the day the entry came on last week of September. Okay, so if you had bought that option, okay, on that day, even if you bought it at a high of 13.65 or 14 roughly here at these levels, so your closing price of option would be here. The option went from 14 rupees to 30 rupees. Okay, it's almost 200% return. Because of this tempting result, people tend to go into options. Whereas in our case, we got only 18. In the previous future, you got 18 points of Biocon. Assuming about a 400 is the lot size, assuming 400 is the lot size, or 4,000. It should be 4,000 roughly, 3,000 to 4,000. 4,000 into 20. Quite a profit. But here, people get tempted with what price you buy and what price you sell. But the beauty here is many times price will suddenly disappear. Sometimes you buy an option at 14 rupees. In no time, it can come and become 0. If you are not entering at the right level. So if you try to enter at our power pattern levels, very good. What is the biggest benefit here compared to futures? Forget about the margin and other nonsense. That is not really a benefit. That is actually a curse. That is like tempting you, right? Why do you think people fall for Ponzi schemes? People fall, invest 1 lakh, I'll give you 2 lakh next year. That is a Ponzi scheme. In fact, options are Ponzi schemes only, if you don't know the science behind it. What is the second method? The first way to go long is to buy a call. What is the opposite way? You can make profit when the market goes up, both as a buyer and a seller. So when you want to buy the insurance, you should buy the call insurance. If you want to sell and make a profit, you should sell the put insurance. Buy a call, sell a put, or buy a put, sell a call. These two are the same direction strategies. Now shorting the option is again a scenario where whenever the price comes to your demand zone, you can think about shorting it, provided you think the price will go sideways. As a trader, we don't expect to go sideways, right? How many of you agree? Majority of the option traders don't have a direction clarity. How many of you accept my statement? I repeat, majority of the option traders don't have a direction clarity. Now, you can sell a put option to when the price comes into your demand zone, but your margin is same as future because you have unlimited liability. So your margin would be as good as future margin. Next, you will get a chance to eat option premium. For example, you take an entry, the price is not even moving. In such a scenario, you have no problem. You are eating time premium. Next, risk is unlimited because you are not the insurance buyer, you are insurance seller. He meets with an accident, you have to pay money. You have to take care of the complete cost. And finally, you must be very clear with the strike price. Why is that? Do you remember? Even if you bet on 350, even if you reach 340, you don't get anything because you didn't achieve the target. Okay, there's a question from Meenakshi. Sir, is there any buyer at 30? No. Meenakshi, what happens once price goes in the money, the transaction drops, but you will get it. You will get your complete intrinsic value, nothing to worry. Okay, look at the same scenario, the same example, 215 call. Okay, instead of that, instead of buying the 215 call, what happens if I short the 215 put? Okay, it is on this day. For example, this is the peak of the day, this is the low of the day, which is 17th. Okay, in the last week of September. For example, even if you had taken an entry here, finally the option would have expired at around 2 o'clock. I'm sorry, 2 rupees. Okay, which means you got 75% of the premium. You sell at 8 rupees, buy at 2. So you got almost like 6 rupees profit. But the trade-off is it worth it? Is it worth it? All right, that is the whole point. But always it is best to trade buying options until you get clarity. Okay, now let me draw something interesting for everyone. Interesting, give a try. Good. Okay, if you guys want to really learn more of option buying strategies, you can also follow this man, Mr. AP Pune. Okay, this man, by the way, today we launched option Omega. Okay, so this person, try to follow this man. Okay, so he is one of the very few very good option buyers in the country. I look up to him. He's a very good mentor. He's one of the members of the Define Edge family. He's from he is from this company, Define Edge. You can follow him on Twitter. He's called as AP Pune in Twitter. Yeah, this man. Okay, he he plays more of option buying. He's a very knowledgeable person. I met him 2 years back in what do you call what is that, in Traders Carnival at Mumbai. They did it in Hotel Renaissance at Powai. He was one of the speakers there. I had an opportunity to meet him and interact with him. A very senior person, 20 years experience. Just follow him on Twitter. He'll share a lot of insights on options. How many of you know AP Pune? Please do follow a different breed. Okay. So next strategy is directional bearish strategy. All right. The third method is put option buying. In put option buying, again, when will you buy a put option? When you're bullish or bullish. Put is means what? Put it, throw it. You don't want a stock, you buy put option. Yes, Ramu. Whenever you are bearish, whenever the price comes to your flag limit supply, FTR supply, QM supply, you can look forward to buy a put option instead of a short trade. Why? Same story, lower margin, lesser cost, and limited risk. All right. And here is a classic example. Is that a beautiful nifty trade? Very rarely I give trades in our reviews. This is one trade which I gave. Very rarely I give because I was sure shot about this zone. Okay. So this trade I was very confident. I told anybody try to take this trade. Nasima says, Ashok, the arrival is dangerous because of the big gap up. How many? What is this candle? How many of you remember this? I guess this is Nirmala candle, if I am not wrong. Okay. So is that an FTR supply? So in case of a future trade, you take a short at 11,650 level with your stop loss at 11,700 levels, and your target is around 150 points. That is about 11,400, somewhere here. Okay, against a 50-point target, you'll have 1:3 RR. Now, what if you buy a put option instead of this? Okay, here it is, the option. If you had taken even at the high of 200 or the low of 218 levels. So this is 15-minute chart. Which date is this? This is, can someone look at the date and tell me? 9 September? No, it's not 9 September. It's much later. Okay. So roughly from 23rd September. Correct. Okay. So 23rd September, imagine the price here. There is a line. Okay. Even if you buy it at the high of 238. Okay. Which is here. The price would have reached to almost 600 levels. Okay, Ramu is telling he's not understanding. Ramu, the method is very simple. Did you understand this futures trade? Can you give me a yes? Yes. Do you understand this future trade? Do you know why we are taking this trade? It's an FTR. Instead of doing a short at 11,600 levels, you are going to buy 11,000 roughly 600 put. Here is what? I'm sorry, 11,700 put. You buy 11,700 put instead of going short. So when you bought the 11,700 put, that day open high low close is 238 is high, 218 is low. Okay, so on an average, this is your buying level, which is 238. So once you buy at 238, if you had many opportunities to sell at different price levels, but eventually the option expire roughly. I don't think it's an expiry. The option, the last price that was drawn was 467. So it's more than doubled. Same month expiry, definitely same month expiry. Okay, same month expiry. And one point you must understand, whenever you are trading, okay, if you are not confident of the zone at that time, you should take next month expiry. Okay, if you are not confident of the time, give more time. How many of you get this point? How many of you understand what I'm saying? Whenever the time is close to expiry, take next month, because you have more time. You will get more time. The time is on your side. I am not asking friends to roll over. Friends, I am telling you, suppose, okay, if you are buying option, don't buy an option. Okay, there is a universal rule. When you are 1 month to expiry, you can buy an OTM. When you are 20 days to expiry, you can buy an ATM. When you are just 1 week to expiry, you should buy only ITM. Why? Time value will erode very, very fast. How many of you agree? The time value will erode very, very fast. So all I am saying is give more time. When you give more time, the probability of success is high. Yes, of course, it will ask for little more premium. Doesn't matter. It is still good. Or else at the end, it becomes operation success, patient died. Your trade will work, your number will achieve, but it will not come on the right day. And the last method is purely shorting a call option. Narsima is asking, Ashok, should we trade Nifty weekly or monthly? Sir, always trade monthly. If you are buying options, friends, buy monthly options. At least you will have time. If you buy weekly, it will drain fast, it will gain fast. Always remember, a trader is one who focuses on risk, not on reward. A warrior is one who does not focus on the victory of the battle, but failure of the battle, loss of the battle. You should not lose the people. You should not lose your assets, weapons, ammunitions. That is important. Why? If you are sustaining today, you can fight again tomorrow. This is something even most of the equity shareholders to do. They call it covered call also, if they are owning a stock. So I will brief about that concept in the subsequent session. Okay. So in case of a covered in naked call, when you are bearish on the market, you will sell. Okay. Again, high margin, but you will get a chance to eat premium. If price goes sideways, you still make money. In a shorting market, you will make money if you get the direction right. You'll also make money if it goes sideways. You'll only lose money if you go direction wrong. But when you buy an option, You will only make money when your direction is right. In all other cases, you lose money. Always write OTM costs with full time value. That is a universal rule. Okay. The same scenario, instead of buying an option, instead of buying a put option, if you had sold a call option on the 23rd of September, this is what would have happened. You would have taken an entry somewhere here, which is around 160 levels. And the price eventually comes to 20 levels, where you got 140 points. Okay. Here is one interesting observation. This is an SR line. Okay, this is a gap. It's not a flag limit. See properly. Nishi, it's not a flag limit. It's a QM. Correct, Meenakshi. Okay. And the last and important method is the covered call. This is what is called as the rental income method. Most of the big equity holders use this method. What will they do? When you own a house, when you are not using the house, what you'll do? There are two ways of earning money from a property. One is capital appreciation. Second one is renting it. Okay. You will collect rent from your tenant. Similarly, let's say you're holding 505 shares of Reliance. That's a lot size, right? If you're holding 505 shares of Reliance, you can collect premium on the 500 shares held that you're holding. How? Mark the demand and supply zones. Mark your power patterns. Identify strong power pattern supply levels. And whenever the price comes to the supply level, sell an OTM call above that. For example, in the previous example, you had a beautiful FTR, right? Go 5% above and rate that option. So what happens? Number one, price can react from your power pattern. Second, you are one level above the power pattern. When I say one level, it is not LOL. It is a proper level. Why? Your power pattern will reflect the price, whereas this guy will expire worthless. And whatever premium you collect, that is yours. That is your rent. On an average, you get 1 to 2% every month, easily. So your property is your shares are growing. Second, your rent is your option premium that you write every month. Since you're holding the asset, you'll start collecting monthly rentals. On an average, you can easily get 1% a month. 12% per annum, aramse you can make it. But if you get proper grip, you can make it even 2-3% also. Because when you are confident, you can write little closer also. Narsimha says, sir, can we go with people who are writing in OI? No. Don't follow the herd. This is Reliance. Can you see something interesting in this? I see a beautiful Quasimodo. Okay, so you can short above that level. When price comes there, you can short 1440 OTM, 1460 OTM, and so on. So friends, to be honest with you, in options, there are so many strategies. Okay, there are at least 20-25 proper strategies that the Chicago Board of Exchange promotes. These are all standard strategies: covered calls, iron condors, calendar spreads, straddles, triangles, okay, butterfly, credit spreads. All these things, all this information are available in books. There are 2 PDFs. There are 2 books. One book written by Options as a Strategic Investment by Lawrence Macmillan. Second, Options Made Easy by Guy Cohen. These two are the Bibles of option trading. I will give you those 2 books. Okay, there is no point in talking about these things which are already there in books. I want to mainly focus on some interesting strategies which are not available in books. Books you can read, you can learn iron condors, butterfly as per your expertise and fancies, but I am not going to teach them in my workshops. Do you all understand why? Because they are there in books. You can please read them. There are some blogs. I can even download some very good literature on that, and I give it to you. That can also be done. Cool. So what all did we learn? Option buying is an alternative to buying and selling a future. Now you have one more option. If you do in the money buying, if there is liquidity, it is as good as your future, because in the money doesn't have. I am saying, instead of buying a future, you can also buy in the money option, because it is ultimately same as buying a future, because in the money doesn't have time value. Thank you. The option buying generally will be limited risk, unlimited profit, while writing has limited profit and unlimited potential. Always buy ITM options and sell OTM options. Is that clear, friends? Why is that? We buy in the money because it has no time value. We sell OTM because it has time value. Correct? Hence, while writing calls, traders should have a clear stop loss to exit in case their trade is not in favor. This holds good for people, okay, who are not, this is not for covered calls, normal writing. Please remember, friends, most of the option sellers will have a stop loss. Remember, if you don't take a stop loss in option selling, you will have unlimited profit. I'm sorry, unlimited loss. Okay. There's one question by Anand. Can I do price action analysis on naked option charts? You can definitely do that. You can do that. Okay. With this, we come to the end of the first day of the sessions. From tomorrow, we will focus on inter-index strategies, expiry strategies, and non-directional strategies. Okay. Tomorrow will be more of strategy learning than anything else. Okay. Narsimha says, sir, you said Guy Cohen made big loss, which you once said in a session. It was not Guy Cohen. It is our man, option writer. Can you tell me his name? Yes. Any guesses, friends? No, no, no. The author of the book, How to Sell Money for a Great Profit in Options. Think about it. James Cordier. Okay, it's not Guy Cohen, it's James Cordier. Okay, please give AP Pune details. Sir, space type AP space Pune in Google, you'll get it. Okay, Ashok, which time frame is good for options? You need to do deep dive. I would say high liquid index options, you can easily check from 15 minutes. Yes, high beta stock list. I am going to send the link and blog in some time. Okay, so a lot of things for my plate after this session. I will definitely share. All right. Good morning, friends. Welcome to the second day of the options trading module as a part of i3T3 mega webinar. We are in the fourth session of the options trading module. The title of current session is the inter-index strategies. This is a very unique concept where you try to play on multiple indices in order to look for a probable edge in your trade. Okay. Disclaimer, please. So let's talk about Nifty and Bank Nifty inter. Okay. How many of you have heard of straddle? Okay. How many of you don't know about straddle? Okay, sounds good. Straddle is a directionless strategy. Okay, you have power patterns. Okay, you mark your power patterns and look forward for your trade, which means you have a clarity on your direction. Is it not? You know when price comes to a flag limit demand zone, or if it goes to a FTR supply, you are going to take a trade, which means your direction is very clear. Okay. Whereas in case of some option strategies, you try to trade without a clarity of direction. There are so many option traders who don't know the direction of a stock, but they will buy options, they will trade option strategies and try to make some adjustments in order to get their desired profits. One such strategy. A straddle in simple words is a strategy to buy both call and put or sell call and put whenever you are thinking that the market can go in any direction, which means you are unclear with the direction of stock movement. So what we do, a short straddle is used when you expect market to go sideways. Suppose for some reason you think, okay, next 1 week, 10 days, 1 month, the market is not going to move in any direction. In such a case, what is the best thing to do? It is best to eat time premium, right? If the market is going sideways, it is always good to use eat time premium. If you want to eat time premium, what you should do? Should you write option or buy option? You should write options. All right. So short straddle in simple words is writing both options, call and put. Okay. Whenever you expect the market to go sideways. So the primary purpose of this strategy is to eat time premium. Whereas a long straddle is used during results. Okay, always understand this point. Markets make massive moves during result times, correct? One important aspect during news is that company over delivering the market expectation or under delivering the market expectation. Many times when price travels, okay, once the results are announced, the price goes up or the price falls down. You are confident that one of the thing is going to happen, but you don't know what. It entirely depends upon the results that the company is going to announce. In such scenarios, if you are confident that price is definitely moving, but you are not sure of the direction. So you will buy both call and puts. Why? You are looking for volatility. This is not a sideways movement, unidirectional movement, either go up or down, any of that. So that is when you look forward for a long straddle. Let's say Nifty is 10,000. What is short straddle? At the money call sell, at the money put sell. Simple, straightforward. What is long straddle? Either you buy 10,000 call or 10,000 put. So what is 10,000? What is 10,000? 10,000 is the strike price. 10,000 is also the LTP. So it is at the money. It is at the money. Good. Sounds good. Okay. Now, how does a payout curve of straddle look like? In case of a long straddle, how many of you understand that you have to pay a premium to buy a call and put? So this is the premium you pay for your call, and this is the premium you pay for your put. At the end of expiry, if the stock dies at 10,000, what will happen? At the end of expiry, if the stock dies at 10,000, all the premium would be eroded. Ultimately, there is zero intrinsic value. All time value is gone. So essentially, all the premium that you would have paid will be in loss. Now, let us say, for example, you paid a premium of 200 rupees here and 200 rupees here. Okay. So 10,000 is the money you paid. So if you want to make money, if the price stays here, you are in loss. If the price goes up, you are in profit. If the price comes down, you are in profit. What is the level at which you will make some respectable profit? Below this, you make profit. Above this, you make profit. What is the level? Some people say 200 points. Some people say 10,200 and 10,000, 9,800. This should be minimum 10,400, or it should go below 9,600, because you paid total 400 rupees as the premium. Muthu, is that clear? Amit? Okay, sounds good. So, by any chance, if the stock doesn't travel beyond the premium you have paid for both call and put, you are in loss. That's it. So that is what is shown in the chart. Can you make out? Whatever premium you have paid is the total loss. Maximum loss is the sum of the two. Whereas once it goes beyond the premium paid, you are in sizable profits. Now, here is the payout curve of short straddle. How does it look like? Exactly opposite. Now what happens in short straddle? In short straddle, you are expecting the price to go sideways. Your maximum profit is what? The 200 plus 200 rupee premium that you collected from the insurance buyer. Now who are you? You are the insurance company now. You are on the opposite battlefield. You are ready to take a bigger risk. Correct? In this case, for some unforeseen reason, if the price goes beyond 400, you are in loss. Okay, at the end of expiry, if price settles down either above 10,400 or below 9,600, you will have a stop loss. In the sense, you will have a loss. So what is the stop loss for short straddle? Sir, we will discuss this next week. Okay, we will discuss this next week when we talk about betting sizes. There is a universal rule that we need to follow. We will discuss that in detail. Okay, is that clear with straddle? All right, now let us get into the next important aspect called as strangle. What is a strangle? Strangle is again another directionless strategy. In case of straddle, we buy at the money options. In case of strangle, we buy out of the money options. Okay. If Nifty is 10,000, in short strangle, I will go out of the money call, 10,200 call and sell it, and 9,800 put, I sell it. Or if I want a long strangle, I will buy 10,200 call and 9,800 put. Is this clear? Any questions so far? Perfect. Now, how does the strangle look like? What is the difference between the payout curve, profit curve of straddle and strangle? Okay, in case of a straddle, it was a V shape. In case of a strangle, it is a bathtub shape. Why? Because here you are playing not at the money, but out of the money. In out of the money, your premium is lesser. Correct? How many of you agree? The cost of the premium value of OTM call is always less than the cost of ATM call. Good. And how does a short strangle looks like? Exactly opposite. Any questions so far? If there are no questions, we will get into the inter-index strategy. Okay, perfect. Let us move on. Now let's talk about IISS strategy. It's inter-index straddle strangle strategy. Okay. So Sudipta, the answer to your question comes now. So what is IISS? The inter-index strategy is a combination of Nifty and Bank Nifty trading. It's a pure positional strategy. This is not pair trading. This is not pair trading. The idea here is to write one set of a straddle of one index and go long strangle on another index, which means we do a short, we do one set of shorting and one set of long. When we sell, what is the best option to sell, ATM or OTM? Where do you get maximum premium, ATM or OTM? We get maximum premium at ATM. So I want to sell ATM here. Now, when I buy, preferably, if you ask me personally, the best thing to buy is ITM. Why? Why it is always best to buy ITM? Muthu says liquidity. No, it's not because of liquidity. We prefer to buy ITM because time value is very, very low. There is maximum intrinsic value. Superb. The money return must always be equal to the options purchased. So what is it? This strategy can give consistent return if followed in a structured manner. If you do miss any one step, you will be in soup because your position will become naked. Then nobody is responsible except you. You should always be hedged so that irrespective of what happens in market, you will always be in reasonable losses. Okay. Now, select the first day of the current expiry month. What is first day of current expiry month? After Friday, after Thursday expiry, take position on Friday. Yes. Short Nifty at the money call and put. Simple, straightforward. Use the premium received, okay, and buy an equal amount of Bank Nifty options. When you don't get in the money options, you go and buy OTM also. But many times you get at the money or even in the money options here. Do not buy beyond the premium received. So what we are telling, we are telling you just short Nifty options. By shorting Nifty options, once you write it, you get some credits. Use the same money and buy Bank Nifty options. Okay. Adjustments can be done based on volatility. Now here are the steps. Please give me your attention. Let's say the opening price of current month Nifty is 11,500. So what is that we have to write? Somebody wants to see previous slide. I just moved back. Okay, here is the first step. Let's say the opening price of current month Nifty is 11,500. So the first step is to do a short straddle. So for short straddle, what is that you need to do? You need to sell call and put. Sure, Chandra. You will short at the money 11,500 call and at the money 11,500 put. You will get some premium. Okay. Now what next? Okay. The total premium received when you short is around 360, 370 points. And for your information, in the recent times, because of the extreme volatility, when VIX touched 70 levels, the combined premium received is almost 600 points. Sometimes even 800 points. This level almost doubled. Okay. Now, here is a very interesting question. Prakash is asking, Ashok, instead of this, can I do selling Bank Nifty and buying Nifty? Now, let me ask you everyone simple question. How many companies comprise of Nifty? 50. How many companies comprise of Bank Nifty? Okay. Now, how many sectors comprise of Nifty? There are at least 20-25 sectors. How many sectors comprise of Bank Nifty? It's only one sector, that is banks. Now, if I ask you a question, who is more volatile, Nifty or Bank Nifty? The most volatile is Bank Nifty. Some people are telling Nifty is more volatile. Okay, people who think Bank Nifty is more volatile, tell me why. Why Bank Nifty is more volatile than Nifty? Shivangi says there are only few banks, that is particularly only one sector. So liquidity is more participation, no. The concept is very simple. In case of Bank Nifty, there is only one sector, which is banks. Any news on banks, bank will move, boom. Either it will go up or go down. It just need one bloody trigger. But think about Nifty. Let's say there is a negative news on IT. Okay, all software companies are falling. The same day there is a positive news on FMCG. All FMCG stocks are going up. Now what would happen to Nifty? Assuming roughly they have reasonable weights. Don't you think Nifty becomes neutral? Don't you think Nifty becomes balanced? Can there be such an opportunity in Bank Nifty? And Nifty is a combination of 50 stocks. It's a huge. It is the pulse of India. It talks Nifty is the pulse rate of India. In case of Bank Nifty, there is no averaging. Okay, I will give one more example. If you draw a moving average line, a 20-day moving average and a 100-day moving average, Which will move fast? Twenty-day moving average. Everyone convinced? Why? Why not the 100? Because the 100 is very big. It takes lot of time to make a movement. The same thing holds good with Nifty and Bank Nifty. Is everyone convinced why I am shorting Nifty and I am going long Bank Nifty? Why? Because I want Nifty to go sideways and Bank Nifty to go move up and down. Correct? Now, statistically, if you ask out of, let's say 50 months, okay, not just 1 month, 2 months, or 1 year, which is about 4 years time. Out of 50 months, according to you, how many times Bank Nifty dominate Nifty with volatility? Or take 100 scenarios. Some say 60%, some say 70%. Okay. So don't you have a natural domination over the scenario? Now tell me, when will we lose money? When will this strategy fail? Tell me. Case 1, case 2. Okay, I erase. Case 1, case 2, case 3. Okay. Nifty moves sideways. Bank Nifty moves sideways. Nifty moves up. Bank Nifty moves sideways. Nifty is sideways. Bank Nifty moves. Okay, when I say Nifty moves up, it can be up and down. Okay, don't get confused. It's both. Now, in first scenario, what will happen? Would you incur any problem here? In first scenario, what will happen? Some people say loss of premium. Whether you make money, lose money, or gain money. Talk about overall strategy. Nothing will happen. Why? The short Nifty will lose money. I'm sorry, Nifty will make money, Bank Nifty will lose money. But you bought Bank Nifty from the money you gained from Nifty. So it is neutral. It is no loss, no profit. What will happen to second one? This is where we lose. Why? Because I want Nifty to go sideways and Bank Nifty to go volatile. And I make a lot of money when Bank Nifty moves big time and Nifty goes sideways. And in this, there's one more scenario. This is one more scenario. We didn't even consider that. Nifty also moves up. Bank Nifty also moves up. Correct? Okay, in this kind of scenario also you can make lot of money with proper adjustments. And the icing on the cake is, I will show you. If the stock moves like this in a month, or if a stock moves like this in a month, you'll make a lot of money. You'll make a lot of money. I'll explain you why. I don't know how many of you understood this line. That's okay. No worries. You'll understand in the session. Okay. So now everyone have understood the underlying principle of this strategy. You want Nifty to go sideways, Bank Nifty to move up and down. Perfect. So once you receive the premium, you will receive a combined premium. In the previous days, the premium was around 300, 350. Okay, nowadays it's 600. Premium almost doubled because volatility has increased in the recent time because of COVID. So the premiums are very, very high. So what is the total amount that is credited? Multiply the value into 75. Why 75? Lot size is 75. So 24,000 credit you received in this example. So this is a theoretical example, friends. Practical we do. Okay. Everyone clear with first step? Take the Friday opening price, round it off to the nearest strike price, short Nifty at the money call, at the money put, multiply by 75 with the total premium you shorted, you get a value. That is the credit you received. Give me a check. I'll proceed to next steps. Okay, step 2. Total credit by 2. What is the lot size of Bank Nifty? 20. So you have two options, right? So D for why? There are one call, one put you wrote, right? Again, you need to buy one Bank Nifty call and one Bank Nifty put. So divide by 40, you get 600. Now go back and buy Bank Nifty options whose price is 600. Let's say the Bank Nifty at the beginning of month is 30,000. Okay. Look out for Bank Nifty OTM options on either sides whose price is 600. If you are able to get ITM options at the same price, fantastic. You can still then, for example, 30,400 call at 600, 29,600 put at 600. OTM. If it is ITM, you will probably buy 29,600 call and 30,400. Whatever money you sold, the same money you need to buy. You cannot spend more. Whatever you earned, you burn. That is the bottom line. Okay. Yes. Next. The third step is the adjustment should be made by the rest of the month. Okay. The adjustment should officially be made by the rest of the month. Try to exit One of the short options, once its value falls 75%. Okay, see, you have shorted two options. If price goes up or down of Nifty, one option will go to zero, right? How many of you agree? Okay, sounds good. Watch your price action levels. Try to close long options at appropriate power patterns for maximizing profits. Okay, now if you have not understood so far, let us take the example. Okay, and then let us do the exercise. Is that clear? Now every one of you open your systems. And open NSE site for live demo. Okay, now friends, so let us take last month example. Now go back to last month expiry. Okay, how to see data? I will go to old NSE site. Okay, I'll go to products. Everyone understand? Products, equity derivatives, historical data, search, contract wise archives. Everyone know how to dump, get the historical dump? Okay, now, so the first step is I need to get first, before you start buying options, what is the first step? Does anyone remember? If you have made notes, tell me what is the first step. I need to first go and find the price of Nifty on the first day of the current expiry. So I'll go to index futures, Nifty 2020 expiry. Which expiry date I have to take if I have to analyze last month? Is it 28th May? Everyone agree? And I'll take say 90 days data here and say get data. I want everyone to participate here because I can't do this two exercise two times. I only do one time. So you need to understand end to end. If you miss it, then you'll have to watch recordings for the whole proceedings. Now, 28th May is expiry, which is the first day after expiry. Go and check the previous expiry. 30th April was last expiry. So for 28th May expiry, the first trading day is 31st April. There is no 31st April if I'm not wrong. So it's 1st May. 1st May is May Day. Correct? So for 28th May expiry, the first trading day is, I guess, 4th May is the trading day. Everyone understood? 4th May is the first trading day of 29th May expiry. Okay, awesome. Now go to the data, identify the 4th May. I'm sorry. Here is 4th May. Okay, the closing price on 4th May is 9285. All right. So what is at the money? What is at the money of Nifty? Muthu says 9,300. Okay, superb. Now make a note of 9,300. That is a closing price, okay, not opening price. Opening price was 9,400. I don't think in the morning instantly you can open. Okay, for this example, to demonstrate, I am just taking a closing price. Okay, when on the day we can always do any time during the day. So opening price was 9,400. You can pick anything. Okay, I am just taking closing price to give a logical ending, because I don't know what is the data in between the day, correct? When we are trying to do live trading, okay, you can't pick the opening price. Exactly 9:15, you can't punch the order. Options will not even emerge. It takes a minute or two for all options to show up values and real liquidity emerge. So I'm just taking the closing price for all practical purposes. That's all. All right. So 9,300 we will take at the money. So what is the first step? So 29th May is expiry day of May. The first trading day of May is 4th May. Nifty price on 4th May is 9,285. Nifty ATM is 9,300. So sell 9,300 call and 9,300 put. Now can someone go and find me the closing price of 9,300 call and 9,300 put on 4th May? Or you guys want me to do it? Anyone? Can you try? Okay, I will show you once. Later you need to help me, okay? For Bank Nifty you need to do. Again, I'll go to NSE site. I love using the old NSE website. I don't like the new one, so I pick that. Don't mind. Products, equity derivatives, historical data, current contract wise archives. Now, index options, correct? Choose index options. Nifty 2020 May expiry. Call option 9,300 strike price, last 90 days data. Get it. Everyone clear? Now go on 4th May. Okay. So on 4th May, the closing price is 365. Okay. 365. Okay, you shorted 365 call. Santosh gave the right answer. Very good. Very nice. Okay, 365 call we are writing. Can someone make a note of it? Sold, sell, 9,300 call at 365. Sell 9,300 put at. So put is easy. Just change it to put, you get your answer. Scroll down 4th May. 383.65, 384. Very good, Susman. Thank you. 384. 384 rupees. Step 1 clear. So what is the total investment? 365 plus 384. It is 749 points. Can you guys imagine? In the previous example that I was narrating, it was 380, around 350, 380, which is this is almost double. You know why? Because of the extreme volatility in the recent times. The premiums are very, very high these days. And in the recent times, trading is also very, very difficult. I know so many traders of the recent times struggling. Why? Because of the extreme volatility. Anyway, into 75. 56, 175. Total credit. Any questions so far? You guys can move ahead of me. I will go little slow so that everyone understand. Those of you who are unable, who are able to understand, start going to the next step and throw me back the values. Okay, this one I did a mistake. I should have done this on an Excel. Life would have been very easy. I don't know why I did that nonsense. Okay. Is this visible for you, friends? So, for example, sell 9,300 call 365, lot size 75. Strike, option type, premium. This is a matured way of doing things. I'm sorry. Okay, guys. So the second one is again sell 9,300 put. Premium was 384. Lot says 75. So total this is the total value of investment. Perfect. Now the total value, you can even put it here, equals sum of 56, 175. That is what I got. Okay. Now divide 56, 175 by what? 40. So 1,404. So I need to buy a Bank Nifty put at 1,400, buy a Bank Nifty call at 1,400. Now If you remember, in the previous example, the theoretical example we saw it was around 600 points. Here it is 1400. Okay, it's a bomb. No wonder market is that abnormal and volatile. Anyway, now it's important. Now friends, go and tell me what is the Bank Nifty closing price on the 4th of May. I'll copy this Nifty and paste it. Susman told, say it again, my friend. Index futures, Bank Nifty 2020 May expiry. Okay, last 90 days data, get it. So 19,000. It is 19,000 close price, 19,632. Perfect. Okay. The price of Bank Nifty on 4th May is 19,632. So what is the ATM? 19,600. Now what is my rule? Buy Bank Nifty options at 1,400. That is the important point. Not just buying Bank Nifty OTM or ATM, whatever. Good. Now what? Buy. Next is Bank Nifty. Clear? Good. Friends, I have one doubt. When I go to, I do remember that Bank Nifty index value was changed to 25. But I still see Nifty Banks 20 only, which means it was proposed only. Okay, I'm looking at 20 as lot size. It is still 20 only. Somebody suddenly said 25 is lot size. I got confused. How can I miss it? They proposed it, but they never changed. Now, come back to Bank Nifty. Now, what is the step? What should I choose here? Index. Index options. Very good. I need to choose index options. Bank Nifty. Year 2020. May expiry. Maybe call option. What was the at the money? At the money of Bank Nifty was 19,600. Now let me check what is the at the money price of Bank Nifty on that day. So 4th May, close price 1,135. Okay. Now what is the price I have to buy? I want 1,400. So if you want more premium, you can now go in the money, no? I have to go in the money, not at the out of the money. So I'll change 9,500. 9,500 is almost 1,200. Let me check 9,400. I'm sorry, 19,400. Something is wrong. 4th May data is not coming. Anyway, no worries. We'll check 19,400. Okay. Fourth May. All right. So 19,500 call. By 19,500 call. Premium is 1186.55. 1187. Okay. And this one should be buying, no? It's minus 20. Now let me go back and check 19,600 put. So 19,600 put on 4th May is around 1,000 rupees. Yeah, this one, 1,000 rupees. So I'll go up. I'll go 19,800. Fourth May 19,800 is 1,200 rupees. Okay, let me check 20,000. Not a big difference, only 90 points. So let me do this. I'll buy 19,800 only. Okay, good. So 19,800 put. What is the price? 1202. Okay, so I earned 56,000 and I have spent 47,000. Balance is around 8,000. I could have utilized this. Still, it's okay. But this number should never be negative. Balance should be positive. Now, what is the first step? Now, go back. The first and foremost thing is whichever option, whichever Nifty option which goes below 25% of its value, square off. Correct? Now we need to go a little aside. Okay, now this is exit. Exit price, total, So the first and foremost thing you should do is now I go back to Nifty options, call option, 9,300 put option. What happened? So you sold this option at 383. What I'm telling you is, if this option goes to 25% of value, which means 75% of value is eroded, then you sell it off. Do you see 95 rupees anywhere? Do you see 95 rupees? You see here, last day of the expiry. Everyone agree? Okay, fine. Now let's see what happened to put. 4th May, he was 365. Okay. So who is the first guy? Who is the very first guy who essentially became lesser? Call. The put happened on the last day. The first guy to lose erosion was call. Correct? Can everyone give me a check? So the erosion value was 365 into 0.25. So 91. If it has gone below 91, I square off. It happened on 18th May. Okay, so I will make this entry. Exit is correct. Total value is into lot size. So profit or loss, this landed in profit. Everyone clear till this point? I'm going to send this Excel to you guys also. So don't worry about that. Please focus on understanding. Okay, so we first square off the short. Whichever short. Okay, the first short. Then let us see what happened to other guys on expiry. Okay, so put, what happened to put on expiry? 4th May, 383 became 0. Okay, now there is one clause here. The best thing is, you remember when I was drawing the scenario, I drew like this. If this is a scenario, it will be phenomenal. Every time it can either go like this or go like this, or it can go like this or go like this. It can go in any direction. So generally what we do, we try to close the first guy at 25% premium. Now this guy, I will only sell this fellow again at 75% premium, assuming he will bounce back. Everyone agree? Or else I will take end of the month, it is 0. So this is a profit on put. Okay, on the last day of expiry. Now wait for the bomb. Okay, now the real losses will sink in. Bank Nifty would have troubled you. Friends, you should never square both on the same day. You should only square the first guy whenever you see 75% premium erosion. Now look at Bank Nifty. So Bank Nifty 20,000 put went from 1,290 to 834. Who is the put here? Bank Nifty 20,000. Is it 20,000 put that we took? I'm sorry, 19,800, right? Yeah, I'm sorry. Yeah, okay. 19,800 put, 4th May, we sold at 1,202. Yeah, correct. Okay. So closing price is 636. So we sell at 636. We bought at I'm sorry. We sell. This is what N4 into L4, right? Okay, this is just lot size calculation. Okay, into okay. So technically, I bought. Let's not do this. This is confusing. So delete it. This balance is equal to sum of these two. I'll calculate this way to avoid any confusion. Minus of sum of these two. Okay. Okay. Now this is correct. So now total profit is equal to 12,000 I sold, but I bought at 24,000. 11,000 loss. Okay. Now what happened to the next guy? 19,500 call. 4th May 1186 1187, correct. He became 0. Okay. So which is equal to 0 minus okay. Now so the total balance at the end of this game is 14,000. Now let us assume that we did not close this guy at 0. Let us assume that we did not close the put at 0. So I'll take the whole thing is scenario. If you close the second sell option at 25% after at the end, if you close the second sell option at the 75% premium erosion. So if that is the case, this is equal to premium into 0.25. Okay. Now what did friends? I am not going to square off in this whole process. We just did a vanilla donkey process without any intelligence, without bringing any of your power patterns, without bringing any of your so-called technical knowledge that we have learned in the last few weeks. Everyone agree? We just did a mathematical study so far. We just applied our simplistic thoughts. The only math I have done is that at 75% premium erosion, I will cut off my sell calls. Can you tell me why I was doing that? Can someone tell me why I was doing that? Because market can bounce back. Very good. In a super VIPSA market, both side if you square off, if you can square off at profit, what is available now? Because the only guys in the entire 4 legs who can give unlimited loss is these two sellings. Because in case of Nifty, you are insurance company. In case of bank Nifty, you are an insurance purchaser. Once you close these two fellows in profit, what can emerge is some profit or no profit. Are you guys with me? Okay, forget this. Let's I mean, there are all kinds of people. Okay, don't take this. This is theory. Let's say this is practical. Let's assume you square off only at 75% as a rule. And now let me tell you, now which is correct in these two? Friends, which is correct in these two? Second one, not at all. Not at all. Again, it is theory of probability, right? When you are doing continuously 10 times, 20 times, the theory of average will take over. But only point is you can't trade this in Jan and this one in Feb, March, this one, April, this one. You should stick to one process. You stick to one theory, there is a respectable profit. Everyone agree? Either you stick to the first one, and don't think if you do the first one you're intelligent. How many of you agree that next month there is every chance that second one can give more money than first one? Can you all give me a check? How many of you agree both are fine? So it is no longer theory and practical. It is just scenario 1, scenario 2. That's all. In one scenario you will lose money. In the next scenario you will make money. Correct? There is nothing like perfect. There is one question. Why not square of Bank Nifty also at 75% erosion? What is the point? See, once you square off your cells, the Bank Nifty can someday go big bang and land somewhere. If you are okay, if you are so joshful, let me give you a solution. Whichever Bank Nifty which will double, which will recover both the money. So how much you spend? 35,060, right? The total cost of Bank Nifty premium. Sorry, it's here. Bank Nifty you spend how much? 477.80. So 477.80 divided by 20. So whenever it goes almost 2,300 points up on one side, square off, then you can look for a good profit on the downside. If you want to really book profit, book when the price of the option doubles. How many of you agree? See, in this case, in Bank Nifty, you earned 2,300 and you lost 2,300 points and you gained only 600 points. So in a nutshell, almost 1,600 points were lost. But this scenario will not happen all the time. Okay, so the crux of the matter is your unlimited liability is coming from the two Nifty guys. Square of them in profit, then you're relaxed. Everyone get that? So what is the first step? When Nifty goes either up or down, one of them will lose 75% erosion. Okay. Okay, Sudipta is telling something on 20. Which day, sir? Put is it? What is the put premium for us? 19,800 put. So 4th May. Oh, okay, that way. Okay. All right. See, the sum of premiums is equal to, see, the sum of premiums is 2,389. Sudipta is telling for PE, if you could have, you had a chance to square off. Yeah, you could have done that. Who stops you? You could have done that. Who stops you? I mean, that is next case 3. See, that is what I'm telling. That is case 3. If you also sell your option, buy Bank Nifty at total premium paid. Okay, when if that is the case, if you had squared off this put, you could have got your money back. So technically, instead of this guy becoming 636, this guy would have been 2,400. Then the entire scenario would have changed. But I don't want to do that. Okay, case 3 here now. So you are telling the total premium pay 2389. So our exit here is here 2389. Okay, now can someone tell me, is this correct? Can someone tell me that squaring of the put option at double the premium is correct? There is nothing like correct or wrong. It is your judgment and it's your choice. If you ask me, Ashok, why are you squaring off at 75? Why not wait for 0? I don't want to wait for 0 because at 75% almost I saw enough erosion, and remaining 25 I don't want to lose. It is like 1:3 trade. How many of you get this? After 75% premium is eroded, the 25% premium is what, like 1:4. Why should I take a target of 25% and lose 75% upside? That is nonsense. Okay, now keep all these scenarios aside, stick to this thumb rule. Let this be the basic mantra. It's a good analogy we have done. All I am telling is when Nifty call or put, whoever loses 75% erosion, square him, and the second guy comes into luckily 75% erosion, square him also. You're done. Your job is done. And Bank Nifty, don't mind. Even if you leave till expiry, it's okay. Because if the Bank Nifty tracks a unidirectional trend, can you guys imagine last during the COVID times, this strategy would have done wonders. Why? Bank Nifty jumped 5,000 points, 10,000 points. Correct? What is a stop loss for short position? One side you're anyway cutting, no? One side you're already cutting, right? Dinker? Anyway, I'm going to send this Excel to every one of you. Keep it with you. And edition 6, course options. All right. So what are the highlights? The strategy has given a win rate of 60% without adjustments. Everyone get that? Without adjustments, it has given 60%. Imagine if you do good adjustment based on your power patterns. The resulting profit can multiply if we square off the short straddles at the opposite demand and supply zones. This is like blind strategy taking. We didn't apply anything here. You can cut off the position at an FTR. When you sold a, when you sell a particular call or put, if price drops to the opposite FTR demand, opposite FTR flag limit demand, QM demand, you can square off. That is a smart way to cut off, no? You can adjust your long position as per your risk appetite also. Focus on power patterns for smart exit. Now it's a balanced strategy. Okay, you are hedged on both sides. And there's an interesting question that's coming up from Urjil. Ashok, what is the worst case scenario? Urjil, worst case, you might lose 10,000%. Worst case, you might lose 10,000% maximum. And it's a very good positional strategy. You will have 1 month to do adjustments. The strategy generated positive equity curve even without adjustments over long run. So without even adjustments over long run, if you religiously follow mechanically, you will still make money. Understand the power of your power patterns. This is a game without any big stop loss. There is no stop loss for the entire 4 sets. And I still didn't get a single important question from anybody. The question is, should I square off and should I take entry at the same time? All 4 trades entry should be taken at exactly at the same time, friends. Sanjeev sir is telling, Ashok, have you checked the strategy for weekly, sir? No, you can check and come back to me. Okay, so exiting at the right time is a crucial thing here. And friends, only one lot. Only one lot. Until you generate 50,000 profit, you should not go to second lot. If you go, I am not responsible. Narsima is asking, Ashok, what if any day volcano or major news come like war? Any war, even, okay, if China bombs India, nothing will happen. Why? You are hedged on 4 sides. Correct, Narsima? You have calls and puts, right? Bank Nifty. Yeah, they'll all will keep adjusting. See, when you have all the 4, you'll hold it till the end, no big deal happens. Exactly. Approximate margin required, you guys should look at okay, F&O. We don't trade futures, right? We trade only options. Nifty, let's say I want to trade 30th July. What is Nifty at the money now? 10,244. Nifty strike price 10,244, right? 10,200. Okay. $275 calls, sell, add 1,40,000 and then put, add Nifty 20 10,000 3 lakhs. Okay, now Bank Nifty 30th July. 21,300. Around 2,75,000 is the overall margin. Okay, that is the overall margin, but the overall I don't think they will block that much. It will be little lesser. Around 2 lakhs roughly would be there. 2 to 2.5. 2.5 would be optimum. No. Hold on. Combined margin requirement is this one, right? Okay, folks, this is the one. Can someone help me? Am I right? Yeah. So it's not a big margin. Okay, let it be even 2 lakhs, no problem. Because you have both Bank Nifty on your protection. There is no unlimited liability. With this, we come to the end of the session and I'll expose the lines for Q&A. So was it interesting? Okay, now go and do an analysis, do a study. Okay, my request to every one of you, next 3 months, do a mathematical study. There was one of our colleague who used to regularly update mathematical study and he used to update, sir, today this is a profit, today this is the overall profit. He used to put it. And you don't have to trade this. Please track it. Understand the intricacy, understand when to exit. But any day, by any chance, you cut one position, you're doomed. Okay, it becomes unlimited risk and don't take any panga. And if you don't understand, no problem, it is very simple. All we did is pure mathematics, no rocket science. You just have to go and see it once again, then it will be all right. Prabhakar says, sir, see your Excel based on 25 Bank Nifty. Sir, it doesn't make any big difference, sir. Okay, so this guy came into a minor loss of from 6,000-7,000 loss. But one thing, when you when the lot size changes, your premiums also changes. Okay, so technically next in the future, maybe after 3 months, then we can check. Okay, then we can validate. Even then, no worries, right? 1,000 rupees per month is no big deal, guys. Come on, don't look at it from that angle. Even after how many times you lost 1,000 in a single bloody trade? This is a strategy. If it's losing 1,000, I'm telling it can even lose up to 10,000, no problem. But it will give you a lot of strength, confidence. This is something which you can scale. Once you get grip, you can play 10 lots and sleep peacefully at home. Okay, all right. So Urjil is telling Ashok, should I always square off shorts before Bank Nifty? It's not about that. My point is simple. Bank Nifty is not your enemy. Your enemy is Nifty. Why? You are insurance company. One tsunami, one earthquake, one COVID, you are in soup. So get out of Nifty ASAP. Bank Nifty is fine. Because in Bank Nifty, any tsunami, any earthquake, any corona will help you. Because Bank Nifty will go berserk, it goes volatile. Okay. Sir, why not we buy call and put same in Nifty? Vishal, what do you mean by same? Yes, Anas. Every month, Friday, the first day of expiry, you can take this position. Okay, is power pattern required? Yes. If you impose power patterns and you try to take exit at appropriate levels, your profits would multiply. This is blind vanilla without any intelligence, and it is still good. Okay, and Narsimha is asking, what if the option premiums are low and I have to buy Bank Nifty option, ATM options, OTM, anything is fine. But for the fact of the matter is, if you are getting ITM options, you are good. Why? Your trade already has good intrinsic value, right? You are not having too much of time value in your entire premium. Okay, and now Susman is asking, okay, when one side Nifty goes to 75% erosion, the other side would be increasing. No problem. First cut one side in profit. The second side is under control because Bank Nifty is balancing it. Okay, it is balancing it. So you don't have to panic. Narasimha says, can I just do option straddle in Bank Nifty? That is not inter-index strategy. That becomes just another straddle. You can do that. Okay, great. Discussed about inter-index strategies, which means there are two indices and we will merge both of them in order to look for a reasonable edge. I hope every one of you enjoyed it. And in this particular scenario, what we are going to do is to create a strategy which will not make you any big loss. When I say big loss, officially it means small losses are inevitable. Okay, so always we say stop loss, right? So what is a stop loss? Are you stopping a loss? Stop loss is not stopping a loss. Stop loss is minimizing a loss. In fact, stop loss means stopping a big loss. But with stop loss, there is a loss. English is a funny language. Everyone get that? Stop loss is just stopping big loss, not small loss. We are all facing small losses. So we'll try to understand the concept of non-directional strategy and how we utilize it for various adjustments. Disclaimer for all. Let's talk about the non-directional trading strategies, where direction is not critical. Okay, we call them neutral models. The non-directional strategies are based on volatility and sideways movement. You can set them up without looking at your power patterns. However, if you may get much higher returns. And those of you who have not got the grip so far can try this approach. These strategies must be followed religiously without any stunt. Okay, any illogical positions may result in naked trade and unlimited losses. Please read this statement carefully. Okay, now let us try to understand the strategy. It is a concept where you take a future position without a stop loss. But instead of a stop loss, you will have an hedge. You will have a proper hedge. And that's the first step, ideation. Only trade high beta Nifty stocks. Okay, Nifty 50. In that too, if you focus on Nifty top 25, that would be very good. The concept is applicable for both longs and shorts. Never trade illiquid stocks. Always take positions as a family, no single legs. If you are taking a single legs, we have to trade the stop loss game. If you don't want to trade the stop loss game, you need to trade all the sets together as a family, which is mandatory because any loosen leg will create unnecessary problems. Respect the hedge and never play stunts with it. Now, here is the detail. Buy the future. What is the future? It is the asset. That is what you are going to drive. Immediately buy an insurance. You bought the future. If you take a long trade, that is your car, buy OTM put, which is your insurance. Instead, if you short a stock, if you short it, then buy OTM call. So just do the hedging. That is a simple step. Then sell at the money call. Sell at the money call. And sell OTM call 10% away. Okay. So Narsimha is asking, Ashok, you already said you don't have to require power pattern. You don't require if you don't know. If you know, you can apply. There is no pain in trying at that level. But this concept is unidirectional. I mean, multi-directional. It can go up, down, wherever it wants. This is a concept which makes money through volatility. The whipsaw should give money. Okay. Now, think about it, friends. Answer my basic questions. So I am buying the future, which is the asset. What is the direction of this asset? It is long. Okay, which means you're looking for uptrend. Now you bought an insurance, you bought a put. When will this insurance make money? When it falls. Very good. Now you sold an at the money call. When will this guy make money? When it goes down. Okay, and it not only goes down, but also if it goes sideways. Very, very important. This guy is going to eat the premium, correct? Let's say you buy a stock, let's say Infosys at 1000. After 20 days, if it is at 1000, what happens to your premium? Your premium will erode, right? Whatever at the money call option you sold, you will buy it back at a cheap price, so you will end up in profit. There shall be erosion. And what is the universal rule here? What percent of erosion will cut off? 75%. Thank you. So this asset also same rule. If at all the price moves 75%, kill that asset. Don't hold it longer. If you have already eaten 75% premium, nothing like it. That's more than enough, I must say. All right. And the last one is selling OTM option. When will this happen? Once you buy a future, you sell a note, you buy an OTM put, which is your insurance to protect any downside fall. Then you sell an at the money call. An at the money call will help you to eat premium if the price goes sideways. Okay, and the last sell the OTM will give you some instant premium because it is 10% away. How many stocks goes 10% away in a single month? It will go. We don't deny. But it can go 10% up, it can go 10% down also, right? It can go sideways also. Anyway, so this one also, if price goes downwards, it will be in profit. So there are 3 guys betting downwards and 1 guy betting upwards, correct? So now this trade, if it fails, you'll be very happy because there are 3 people who are betting downside. I always tell people, sir, most of the trades are failing. I say, then try this strategy. Anyway, let me move further. Here are the concepts of adjustments. Step 1, if trade works, if your power pattern works, your future is in profit, right? Your asset is profitable, square off as per your choice. Okay, next, if the script comes to second sell call level by any chance, if the price moves up 10%, what will happen? From that moment, your sell call would be in unlimited loss, correct? So what we do, we square off that call and go to the next call. We will not disturb the put because it is your insurance. It's just a small premium paid. Okay, and that premium also you earned from your second sell call, almost half of it. Now there are only two people fighting. The at the money call is losing money, your power pattern is making money. So they both are fighting each other. There is an hedge on both sides. Now the beauty is, imagine a fake out where your trade fails and then comes up. That is your bumper. Why? Your sell call will make money and your future will also make money. If the script moves to third level, square off that call and go to next call. If price keeps going up, keep pushing the second sell call away. Okay, this is step one. If price works. Now, step two. If trade fails, what if we make a loss? If we make a loss, then the future is in loss, but put will give you protection. Because put will be deep. Slowly it will become in the money, and for every delta it gives you the same amount of profit. So every penny loss in the future, slowly the put will compensate that loss, so you don't have to worry. This is the primary reason we always say the loss on the bottom side is limited. You don't have to worry too much. Why? There are three guys betting on the downside. Your challenge now is controlling when your trade works. When your trade fails, you are very happy. Everyone agree? If your trade is working, you should feel bad. In this scenario, if your trade is in loss, you should be very happy because it will make more money. The sell call will make money and the put also makes money and compensate the future losses. Correct? The sell call, whatever 3%, 5% you would have written off, that guy is making money. The second sell also, your put also made money. So all compensation is adjusted. If the price touches the put level, because you took an OTM put, no? When the OTM put becomes ATM, square off the second call and sell 2 strikes lower. Before, what we did when the trade was working, the second sell call we were pushing him away. As and when price was going and touching him, he was moving away. It's like the kite moving away. Now when price is falling, he is coming towards the earth. When price is going downwards, he is coming towards the price. You need to bring him towards the price. So every time square off and keep booking profit. Because every fall there is a profit there. If price comes there to sell 2 more strikes away. Price is going up, there is an unlimited liability on the second call because future is compensating the first call. So you should push away the second call so that it doesn't get into unlimited liability. Point number one. Point number two, when price is falling, you are in trouble. When price is falling, you are in deep trouble. So at that time, so every time price falling, all your options are making money, whatever you wrote. The premium will erode, right? If you have sold a 10 rupees option, square it off at 2.5 rupees. Simple. There is no major loss in the position. Okay. Now, if there is a zigzag move, this is a blessing in disguise. Sectional trend might not give good money here. A zigzag move will give phenomenal money in this journey. Expiry, yes. If you are 1 week close to expiry, try next month. Any questions so far? Simple, straightforward. Right? I repeat once more, buy the future, buy OTM put, sell at the money call, sell 10% away, OTM call. Okay. For people asking how much margin, please give me time till end of the session. In the end, we will do the calculation. I don't know. I don't know. Maybe 2 lakhs, 3 lakhs max. Next, step 1, the trade worked. Your buy trade worked and HDFC Bank is in profit. The trade is in profit. So square off everything. You know why it is in profit? Simple. Number one, you bought a put. Okay. So you bought a put. Technically, 50% of the put cost you almost recovered by rating the second call. By rating the first call also you recovered. You earned some money. Okay. If the price suddenly jacks up and hit your target, okay, you will not see big profit. It will be very minor profit. Okay. But overall, when you see profit, feel free, cut off everything. If price comes to 1320. So from 1200, HDFC went from 1200, it went up 10%. When it go, square off your 1320 call that you had bought at loss. Okay, you'll have to book a loss there. Okay, and then go and write 1340 call. Whatever loss you made, you'll recover there. You'll go another 10% up and write. Never touch the put. Very clear. Put should never be touched. You'll never square off the put. Put will be there. The only square off you are doing is your sold calls. You're only moving the sold calls up and down. The future which is going upward, the put which is supposed to take care of downward, both are intact. Only call you're pushing. Now try to connect. It's very simple. When price goes and hit the roof of your second call, push it away. Okay. Ramdas says your next call is very close. Then we'll go little away. No problem. You should get good premium. That's all. If price comes to 1340, square off him and go to 1360. Keep moving the sell call away as and when price comes and touches it. Don't allow the price to pass through it. Okay. Keep moving the call away to ensure there is no unlimited liability. This is the bottom line. The at the money call, don't move it. If you are in loss, I mean, if the price is going upwards, don't move it. Because anyway, future and that guy are fighting. This whole journey is all about eating more and more premium. How many of you are able to connect it? Okay. Now, if the trade fails, the future is in loss, your put will give you the protection. No. Ramdas is asking, sir, when the price goes up, will ATM call become zero? No, it will become more. You have sold it. There will be some loss there. But for that guy to become delta 1, it takes time. Okay. The future is in loss. Your put will protect the position. The loss on the bottom side is very limited because you have 3 people fighting downsides, unlike 1 person on the upside. Never touch the put. Now, everyone agree your both sell calls are making money? I am definitely sure both sell calls would have achieved 75% premium emotions. Square them off. Square off the at the money call, kill him one shot, and the second at the money call, bring him down. You again rate whatever journey downside that's gone. Ensure 10% away, whatever call you get, write it off and eat more premium. Like this, you keep eating more and more premium. And whenever there is extreme to and fro volatility, you keep eating the premiums. Okay. Now, what if price goes to 1190? Now, what you should do when the price goes to 1190, put becomes at the money. Everyone agree? When price goes to 1190, your put becomes at the money. Square off your 1320 call and write the next call, the one below. Okay, now price is going down, bring the call down. Before, when price was going up, you are pushing the call away because it had unlimited liability. Now what you are doing, you are bringing the call down, you are squaring off, eating away the premium and slowly coming down to eat. If the price comes to 1180, square off 1300, go further down. And this way, keep moving the call up, down, suitably as the price is moving, and start eating small profits. This will ensure there is no major loss in the position. What about the future? The future is in loss, right? Hold it. Now think about it. After all these things, after all this square off, suddenly price jumps and come to the future level, all loss becomes zero, right? Imagine how much money you made. So future and put never touch. Leave it till expiry. If it is flowing downwards, bring the calls down. If the price is going upwards, push the calls upwards. Eating more and more premium is the crux of the whole conversation. And use the two levers. Your future and your put option are levers. Okay, they will take care. One must take all positions at one go. You cannot say buy future now, I will do hedging later. No, if you want, take all positions at the same time, strictly. You cannot take it later. Never ignore adjustments. Every return call is a liability. Every call that is written is a liability. Why? You are the insurance company there. You are trying to sell as many insurance as possible, and so that those guys don't meet with an accident. Do not miss the process. If you miss the process, if you miss any link, then the strategy would be something else. And any deviation would result in unlimited losses. I told you from the previous session, one of our known friend, okay, he was doing inter-index strategy. He suddenly removed one leg. What will happen? Definitely there will be unlimited loss. This is a strategy we should play only for monthly expiry. Okay, no weekly game. You can try inter-index weekly. I have no problem, but practice it. At least check 10 weeks before you put real money. Never touch the insurance. Who is insurance? The put. Brilliant. Okay, so with this, we come to the end of the session, and the first question was, what is the margin? I don't know. Zerodha margin. Let me take the script price of HDFC yesterday. So HDFC Bank was 1033. 1033. So what I'll do is HDFC 30th July. Okay. Futures by 1 lot. So what is the total margin? 1,58,000. Next. Now go to options, HDFC. Okay. Call. Strike price 10,030. Does it exist? I don't know. Give me 1 second. Let me pick the right strike prices, or else this guy give all wrong numbers. Okay, here is the option chain. So it's HDFC Bank only. Okay. In the calculation we were wrong, right? Okay, understood. 1030, all multiples of 10. Perfect. Okay, so what I should do? This is not HDFC Bank. It should be HDFC Bank, right? I'm sorry. So I'll kill this. I'll do HDFC Bank 30th July, next month expiry. I'll take the future. 550 is the lot size. I add 1,33,000 is the margin. Next, I'll go to options. HDFC call. Strike price 10,030. That is at the money. Okay, so I will sell one at the money option. Correct? Understood? At the money call I have done. Now I'll go to put. I'll go one level down. Shall I buy 10,030? Shall I buy maybe 10,010? How much is the LTP here? 10,030 put is here. Sorry, 13. So 10,010 put I'll take. Okay. Or why confusion? I'll check 10,020 put. Buy the put, add. Okay. So HDFC Bank, we took put. What next? There's one more thing we need to buy. Who is the fourth guy? Can someone help me? Call. Very good. What call? Buy or sell? Sell. So 10,030, right? 1,030 into 1.1. 10,130 maybe. 130, yeah. How much? It's giving 1 rupee. 130 is giving 1 rupee. 120 is giving 2 rupees. Okay. I'll take 120. Okay. Sell it. It requires around 1.5 lakhs. Okay. So if you don't want it, yes, 30th July, is it 30th July everywhere? July. Okay. So if you are saying no, it's only 1 rupee, why should we take that pain? Then we'll cut him off. If I cut him off, your requirement is only 48,000. Your requirement is hardly 50,000. Why? Your put is taking care. Okay. You can even play adjustment with these positions. Now the premiums are low. We can even go just 5% away. Give me a second. 10,030, right? So I will do one thing. I will go 5% away. Instead of, so 10,080. 10,080 is around 5 rupees. It's around 2,500 rupees. Around 1.5 lakhs is the cost. See, 1.5 lakhs, you for 1.5 lakhs investment, okay, you're getting 5 points, 5.2500 rupees. That is roughly close to 1.5%, 2%. It's not small money. See, from the overall investment perspective, okay, don't think it as only 1 rupee, 5 rupee. Okay, so if you are having any difficulty with the current setups, you can play around this method. It doesn't give you big losses. You can have comparatively peaceful play, and slowly you can scale up things. Okay, so this concept was purely given only to make sure that those guys who are struggling with the stop loss target fake outs, they can play this game. Okay, so what will happen if it goes sideways? Your put will lose all the premium. You lose the money on put. Whatever premium, future will not give you any money. No loss, no gain. Your ATM call will give you profit. Okay, so you'll still be making money. So if price goes sideways, you make money. Price goes down, you make a lot of money. Price go up, you'll make very limited money. Okay, so that is in a nutshell. Okay, try this, not a big deal. You'll not make big losses because of all side hedging. Your losses would be very limited. You don't have to worry. Okay, this is also like the inter index. There the hedging was done through multiple indices. Here our hedging is done through the same script options. Sandil not required. Sandil not really required. Okay, here max loss will be very less. Yeah, maybe couple of 1 or 2%, 1%, 2%, not more. So per lot you might lose 5,000, 10,000. And see, remember, it is positional trade. You don't have unlimited liability. You have 1 month to adjust things. Okay. Susman says, can I apply this on index? That's your call. If you really want to play index, play inter index. That would be a better game to play. Okay. Okay. So let me start the recording. Good afternoon, friends. Welcome everyone for the last and final session of the option trading module as a part of i3T3 mega webinar. We are in the 6th session of the module, the expiry day trading strategies. Disclaimer for all. All right. Please read it wisely. It is not a warning, it is a caution. It is very important that we always respect risk, because true traders predominantly focus on risk, not on reward, because they know that if your risk is under control, reward is eventually confirmed. Reward is assured when risk is managed. All right. So look at that beautiful statement. If we ignore futures and options, if we take them lightly, we will have no future and we will be left with no options also. Correct? Now, let's talk about this interesting concept called as expiry day low risk hedging strategy with price action. Okay, this is a concept which was derived by Mr. Alchemist Gurumurthy. He is an options trader, a person whom I consider one of the very good trainers in India, who had very good control on his trading methods. Okay, so all credits to him. So here is the concept. Friends, we all know whenever we buy a car, we buy insurance. And in all examples, I put an Innova because I love Innova. I own an Innova and I worked for Toyota. So I started my career with Toyota and naturally I got hooked to this car. All right. Right. Friends, this strategy is applicable to any script, but the opportunity will never come. It mainly comes on expiry days only. Second, however, it works beautifully for Bank Nifty on expiry day. It happens extensively on expiry days. In this strategy, the risk is very, very low or almost nil. But it entirely depends upon your response time. I repeat, in this strategy, the risk is extremely low. Okay, but it depends on your response time. You need to be respond to the situation very fast. If there is a trade, if you don't respond, the opportunity will disappear in no time. You will not even know it came and went. Okay, that is the problem with this strategy. All right, this is for weekly, every week, expiry day. This concept is purely for Thursdays. Okay, every Thursday you can trade this concept. Here are the ground rules. Okay, this arbitrage low risk entry generally happens every week. Okay, you need to keep both Bank Nifty future and the corresponding 3 strike prices, call and put, on the terminal at 9:15 in the morning. Okay, and predominantly in the money options. For example, if Bank Nifty is 25,000, you need to keep 24,900, 24,800, 24,700 call options, and 25,100, 25,200, 25,300 put options, which are in the money options. Is that clear? Once the screen starts updating the bid ask early morning, okay, you will start watching the bid ask only. We will never trade on LTP here. Okay, we will always do verification on bid ask. Look for the rules to pass with a maximum allowance of 10 points, jump to the trade. Okay, so what are the rules? We will talk about it. So what do we trade? This concepts includes purchase of a Bank Nifty future, either it can be a long or short, and a corresponding hedge using a call or put. If you are buying a Bank Nifty long future, what is there to hedge? Call or put? If you are going long, what is your hedge? It's a put. If you are going short, what is your hedge? It's a call. Thank you. Now, if you buy a future, you must buy an in the money put to hedge. It's not out of the money, it is in the money. Remember, if you sell a future, you need to buy an in the money call to hedge. There is no option writing in this strategy, so all of us can be comfortable. It's only a very small premium that you need to pay, and the cost is very low. For example, if I take, for instance, the margin requirement is brutally low. Go to NSE, Zerodha margins. I'll go pick. Okay, another margin calculator. Okay, so what was the Bank Nifty price? Yesterday closing price. It is 21,300. Okay, so what I will do, for example, futures. Okay, what is the expiry of futures? Futures is always monthly, no? Bank Nifty, say for example 25th June. I'll take this one only, upcoming one. I want to buy a future. Margin is 1 lakh. At the same time, I'll go to options. Bank Nifty 25th June. Since I buy a put. Instead of buying 23, what was the number? 23,200? Is it? I forgot. Look at this beauty. 21 is it? I'm sorry. Anyway, it's a buying option. 21,300, right? So okay, I'll buy 21,400 in the money put. Add. What's the total margin? It's not 92. It is 10,000. That is a margin for this opportunity. Okay. Now, let's come back. Here is the concept. Suppose Bank Nifty opening price is 25,000. Okay. And you don't have to worry about demand zone. Okay. Okay. If the that's it. I dynamically did it. So you don't have to worry about your power patterns on expiry day. I will tell the rules. You buy a future. Okay. What you need to do is you need to compare. Let's say 25,000 is the Bank Nifty price, and if you any chance notice 25,100 put at a price not more than 110, that means there is only 10 rupees time value. Yes or no? I repeat, when the Bank Nifty price is 25,000, if I buy Bank Nifty future at 25,000, also if I buy 25,100 put, which is in the money put at around 110 rupees, what is the time premium there? The time premium is 10 rupees, correct? That is roughly the maximum money we will lose. What is 10 rupees in Bank Nifty? It's around 200 rupees, maybe 250 in future per trade. Okay, that is the maximum loss. If I want to short a future, I need to buy in the money 24,900 call at a price not greater than 110. Now there's a question by Sanjeev. He's asking, what if it is 200? There is no trade. If it is 200, there is no trade. That is my answer. Okay, it's direct and simple. So what are we doing here? All we are doing is identifying a scenario where the time value is not more than 10 points between your future and option. I will tell you many times the time value would be less than 0. I will prove you also. I'll explain you. Let us say Bank Nifty opening price is 25,000. Okay, so there is no demand zone and supply zone now. I'll delete that. Bank Nifty opened at 25,000. Okay, you have only two options. Either you go long future and then buy in the money 25,100 put at maximum 110 rupees, or you go ahead and short a future, buy in the money 24,900 call at maximum 110 rupees. This is the math. Very, very simple math. Both side hedged, no tension, no crisis, no black swan moments. Still you will be comfortable. The worst risk in this strategy is 10 points only. Now, how many of you think, sir, it's impossible to buy an option at that price? How many of you think it's not possible? Look at this. What is a Bank Nifty spot? This is something which I captured last year. What is the Bank Nifty spot? Can someone read it? 26,492 is the spot price. What is this call which we are looking at? 26,300 call we are checking. In 26,300 call, if the spot is 26,492, what is the intrinsic value? ₹192. Correct? What is the LTP? What is the bid ask? This happened in front of my eyes. My intern was sitting next to me. I explained this strategy. I had an intern sitting very next to me almost continuously on every Thursday. I told him you should monitor this behavior. And he found this behavior. He took this screenshot also. Okay. And he told me, sir, there is a very big arbitrage here. I'm sure. I'm sure. Have a look. I said, shut up. It cannot happen. Check properly. I ignored him. And he was like, pushing me. I said, no, my friend, it cannot be that much of bid ask. There will be hardly 5-10 points only. And he said, sir, please look at my screenshot just once for my satisfaction. When I looked at it, I went bonkers. If I see, look at the price here. The ask rate was 100 rupees. If I had bought 26,300 call at 100 when Nifty spot was 492, what was my intrinsic value? Don't you think instant profit? How many of you agree? Is it not instant profit? This is a no risk trade. But I was dumb. To be honest with you, I didn't take this trade. This was a screenshot taken by my colleague. Okay. What time this was taken? Around 9:15, 9:30, 9:30 roughly. Okay. Now, what is the spot? 26,492. Intrinsic value is 192. What is the price of option? 77. That is the arbitrage. So I am not telling this will come. Okay. I am the last guy to exaggerate anything on stock markets, because I strongly believe this is a field which requires extensive cleansing, and I am one of the strong critic of any exaggeration of results and achievements. In this scenario, all I am telling is we need an arbitrage of just 10 points. Here it is more, don't worry. I particularly place this slide for you to believe that what I am telling is true. This is only proof of my claims. I'm not telling this is a trade you'll get tomorrow. I don't know. Okay. It came on that day morning, I remember. Now, look at another example. It was some other day. Bank Nifty May future was trading at 25,577. What is the intrinsic value of 25,500 call? 77. What was the LTP? It was 60. Okay, now we will not say price is in the demand zone. I'll say the buy side story. Because wherever I say demand zone, you guys will think power points, power patterns. I do not want that confusion to happen, so I am erasing everything. Now, the first step, go long future 25,000, buy in the money 25,100 put at maximum 110 rupees. Now, suppose you took this trade. What is the maximum risk? The maximum risk is 10 points. Thank you. Now, price reacts from 25,000, it goes up by 25,100. So your future is in profit. Your future made 100%, 100-point profit. Then what happened to your option? Don't you think your in the money option 25,100 put, it became at the money? The at the money guy will not have full 100-point intrinsic value, correct? So his price will come at around 60 to 70 rupees. Overall, you are in profit. Put is in loss, but it will not become zero because it is at the money. No, at the money put cannot be zero, right? Now look at this. Price breaks 25,000 and go down to 24,900. When that happens, your future is in 100-point loss. What will happen to your 25,100 put? It was already in the money. When it goes to 24,900, don't you think there is 200 points in the money profit? It is deep in the money, exactly. So you agree that it has 200 points there? Because that is the intrinsic value, no? Now what I will do, I will square off the 25,100 put and buy 25,000 put. When price is going down, I will do this. Correct? When price goes to 24,900, I will square off 25,100 put in profit and I will buy in the money 25,000 put. Now don't you think it is also same like level 1? What is your current trade? Almost just like new. Okay. Now so I'm sorry if I am rewriting some of these slides. Don't mind. Now what happened? Bank Nifty is at 24,900. Currently future is in loss and 25,000 PE is active. Now from there, if price goes up by 100 points and reach 25,000, what happens to future loss? It recovered. Excellent. You already sold 25,100 PE in profit. Now your 25,000 PE, it will lose some premium. Overall, you are in profit. Okay. Look at this guy. Suppose it further goes down without recovering, it further goes down by 100 points. If it goes 24,800, what you'll do? No problem. Your future will be in 200-point loss. So your 25,000 PE will have 200 rupees profit. Square of 25,000, go to 24,900. Is it simple? If price keeps going down, keep booking profit. Now let us see the cycle repeats. Now let us see the buy side story. Those of you who didn't understand, please concentrate. Okay. Ah, thank you. All right, thank you. Thank you. Okay. Now those of you who didn't understand, please concentrate. Thank you, friends. So this is how traders do, okay? Another classic example. If you do stop loss changes in last minute, this is what you will do. This is how we lose money. A classic example. Anyway, okay. Forget whatever we discussed. Suppose Bank Nifty is trading at 25,000. So I want to sell Bank Nifty future at 25,000 and buy in the money 24,900 call at maximum 110 rupees. Okay. Now only two things can happen. Price can go from 25,000 to 25,100, or it can go from 25,000 to 24,900. Case 1, price goes to down to 24,900. Now tell me what happened to future. Future is in loss. Are you sure? Future is in 100 point profit. Superb. What happened to call option? Now the call option, of course it will be in loss. Okay, but don't you think the call option will become ATM? The in the money call option has become at the money now. So when it is at the money 100%, I can declare that there is no 100 rupees premium. Yes or no? How many of you agree at the money it can never be 100 rupee premium? It will be some number. Good. So you're in profit now. Correct? Everyone agree you're in profit? Because future gave you 100 points, but call option didn't lose 100 points because it became at the money. Only if it is in the money, it will lose 100. The moment it becomes at the money, that burning rate will reduce. Okay, next. Instead of that, price goes from 25,000 to 25,100. Future is in 100 rupees loss, but your 24,900 call is becoming deep in the money. It becomes 200 points. Just square off the 24,900 call and buy 25,000 call. When price is going up, keep buying higher calls. When price is going down, keep buying lower puts. I repeat, when price is going up, keep buying higher calls. When price is going down, please buying lower puts. That is in a nutshell. Any confusion so far? Ramu says the right side is PE, I think not call. Sorry, it is call because you are shorting a future. How do you risk a shorting future? You need to go up direction. So you have to buy a call, not a put. It's all good. Sudipta, perfect. Okay, now let's go to the next step. This time I will type it properly. The sell side story. Perfectly. The sell side story. See? Experience teaches. Now what happened? Bank Nifty is at 25,100. Your future is in loss and 25,000 call is active. From there, let's say it goes down 100 points to reach 25. Future becomes no loss. It's like zigzag. It's like zigzag. So one option you already closed in profit and another option will lose some premium. Overall, you made money. Every 100-point jump, you need to adjust the call and puts. Correct. If in case it further goes up, no problem. Your future is in 200-point loss, but your call recovered all the money. Square of the call, buy higher call. Square of the call and buy the next level higher call. Like this, you keep moving. And the cycle repeats. Let me draw it for you. We'll draw it in an Excel. That is best, no? I'll start here. Yeah. Let's change a different number. Let's say Bank Nifty is 20,000. What is Bank Nifty now? 21,300, right? Can someone reconfirm? Okay. Now, Bank Nifty at 21,300. So buy future 21,300. Sell in the money put. How? Which put I have to sell now? 21,400 put. Correct? At 120 rupees. Am I clear? Okay, now case 2. If the price, now price goes to, so now I will say BN at 21,400. This is BN at 21,200. Is this clear? What's wrong with me? There is no selling. It's only buying. Is it fine, friends? Perfect. Yeah. Thanks, Usman. Thank you, Prakash. Thanks for that warning. Okay. Now let me draw the next step. So now price has gone to 21,400. Future, how much? What happened to future? I have bought a future. So 100 points profit. Correct? Good. Now option. Your 21,400 in the money put. 21,400 put is ATM. So less loss. Overall profit. Now, if price goes down to 21,200, what happens? Future is 100-point loss. Option. Your 21,400 put. 21,400 put at 200 rupees profit. What I should do now? I square off 21,400 and buy 300 put. Is this clear? Now next case. Now Bank Nifty at from 21,400, Bank Nifty goes to 21,500 or Bank Nifty goes to 21,300. I have two options here. Clear? Or in the other case, you will have Bank Nifty at from 21,200, it can go to 21,300 or Bank Nifty can go to 21,100. Boys, is this clear? Okay, I could do some mistakes, so please keep watching me. Okay. Now, if after Bank Nifty 21,400, if price goes to 21,500, what happens? Future is 200-point profit. Option, what happened? Your option which you bought at 110 rupees, okay, option is losing premium. Option is losing premium. Why? Because you bought in the money put option, so price is going upside, so that 110 rupees might become 70, 30, 40 or whatever, some number. Correct? Because it is OTM. Absolutely. Option becomes premium and it is OTM. Brilliant. So overall you're in profit. Yes or no? Now instead of that, if price goes up by 21,400 and down by 21,300, it is back to square one. Future is in no loss. I'm sorry. I'm sorry. If it backs to future is neutral. Okay. Future is neutral. Now what happened to option? At 21,300, your 21,400 put at 110 is still intact. So future was in profit. So 21,400 P that you had got at 110 rupees. Now price went to 21,300, right? So that premium is still there, 100 points. Okay, it's minimum having that 100 points premium. Now on the other side, instead of Bank Nifty going after it goes to 21,200 and if it comes back, this is after going, the first case neutrality is going up and coming down, the second case neutrality is going down and then coming up. Now future is in no loss. Correct? Future is in no loss. Future recovered all its losses. Now what happens to already booked 21,400 put, right? So pending is 21,300 put is at the money. Is it not? Your 23,100 put which was in the money before, it has become at the money. If price goes further down, future, this is very simple, is 200 point loss. Okay, already 21,400 put at 200 profit. Now you have 21,300 put at another 200 profit. Now square of and then by 21,200 put. Any mistakes so far? I'll zoom it once for all your references. Okay. I'll cut this down. You can watch it. Everyone clear? Friends, any mistake in this, please guide me. I could have done some mistake also, because when you're busy focusing, you will do some silly mistakes. Cell E2 second row. So this was future. I buy 21,300 future at 21,200. Future is in loss. At 21,300, future is square off. Future is 200 point loss. Yeah, it's correct. Exactly opposite you do. Just check if I have used any call and put wrong for wrong reason. Ah, you're right. That is a mistake. Thank you. I understood, Santosh. Thank you. Okay, I will save this. Mm, Now let me show you something very interesting. In fact, I have programmed this. Okay, I wrote a program for this whole thing, and we are going to launch this automated tool probably next month. Lot of delays. We were so busy with the moving of office and hiring and so many new things. So all these utilities we are going to launch one by one to all the community. So all i3t3 people, once I launch the utility, I'll give it to you for free. Okay, don't worry about that. But look at this. This guy is nifty. Okay, this is a real-time calculator of those stuffs you said, right? Say, sir, every time we can't track. You don't have to track. You just have to mention the expiry day. See, there is an expiry day entry there. You just have to make that entry. If you make that entry, automatically the system is smart enough. It will understand what you want. Once you post it, automatically the time values will start coming. Okay, can you see time values 5 rupees, 6 rupees? It keeps coming. and this is monthly. Monthly and weekly both are programmed. It will automatically show. Generally what happens, I am making one more utility over and above this. Basically, whenever that arbitrage comes, it should throw a sound. It should make a noise. Okay, forget Nifty. Look at Bank Nifty. Same stuff. Okay, don't fall for this, because this was captured almost at 3 o'clock in the evening. So naturally you will have lot of negative numbers. So that is not important, but just recognize the fact in real time basis we are able to track it. So next step is very simple. I just have to inform AmiBroker that this, you find this scenario, just throw me an alert so that I can punch an order, and this can be automated. Can you see here, for example, look at this. 29,300 put was having 262 rupees premium. It had 35 rupees time value. Can we create algo? This is the algo. I have the AFL code here. I have the AFL code. Give me 1 second. Let me pick that AFL code for myself. Oh, where is this guy? Official handover of expiry day calculator. Yeah. Here it is. Here is the program. So we have all the entire program built. So only thing is, this program has to be executed in real time using AmiBroker. Okay. So that's the interesting part. So more information to follow. So summary, option trading is on expiry day is a stunt. It requires a lot of practice and strict adherence to rules, and any minor deviation might destroy your capital. You need to be little careful. Always start one lot, friends. I always tell this. If you make money in one lot, then only go to 5 lot or 10 lot. Check at least 1 week, 5 weeks, 10 weeks. Okay. Don't blame later that that did not work. These are all food for brain. Okay, in all the things that we learn, some things might not fit for you, some things might extremely fit very well. You never know what is on the plate, but whatever comes to you, whatever fits you, please adopt it. After all, your practice only. This is a least risk trade. You can always try anytime, real time only. You don't have to practice also, but try small lots. Okay, try very small lots. You can raise it whenever you want later. With this, we come to the end of the session on the options expiry. Now it's time for Q&A. Please shoot your questions. Okay, so Ashok, so we have to take view, nothing. What is that you have to do? Very simple. Go to your terminal, insert Bank Nifty on that day, that weekly expiry day. Pick top 3, bottom 3 calls, top 3 puts. If your Bank Nifty is 25,000, put 24,900, 24,800, 24,700 calls, and 25,100, 200, 300 puts. Put it on the terminal. That's it. Nothing more. Brilliant question by Amit. Whenever I am adjusting the trade, the new PE should have maximum 110. Even if it is not maximum 110, even if it's another 5-10 points, let it go in slippage. Still you will lose 500 rupees only. Okay. Now let me tell you a very simple thing. Okay. I'll just give you a perspective. Think about it. What are you doing? Okay. You are buying Bank Nifty future, for example, at say 25,000. So you bought a 25,100 put at 110 rupees. Let's assume you don't do any damn adjustment. What will happen at the end of the day? Let's say there is no adjustments. Okay. Worst case, 10 points loss. Now, if the future goes above 110 points, the premium paid, you are in unlimited profit zone. How many of you understand this? Forget your adjustments. Don't do anything. Okay, let's assume you lose 10 points per week. The worst you lose in 50 weeks is 500 points. That is equal to correct. It will come. Okay, if it doesn't come for you, I am going to launch this program. I think we can track it in real time. Now Prakash is asking, initially tell me which one should I buy, future or which should I buy, future or sell? Do whatever you want as long as your time value is maximum 10 points. Prakash, do you understand that? Do whichever thing. You go long, you go short, it's all same. No. If you are going long, your future will make profit. If you are going short, your option will make profit. It is same. There is no difference between both the trades. The only difference is when the price goes up, future makes money. When the price goes down, option makes money. I am sorry, I am wrong. When the price goes up, long future makes money, option will lose money. When the price goes down, short future will make money and option will lose money. If you have taken a long future and price is going down, then your option is protecting you. And if you are taken a short and price is going up, then again option will protect you. The premium on either sides will tell you which trade to buy. Take any time, 9:20 onwards. See, some days you get that abnormal arbitrage, whatever I took a screenshot. You will get such things. Let me tell you, when I still remember, initial days I never used to believe. I used to send this to Gurumurthy. He used to tell me, he took a lot of time to convince me on this philosophy. I was like, this is nonsense. It cannot happen. How can Black-Scholes model fail? What are the foundation for option data? There's something called Black-Scholes model. Okay, but this arbitrage always exists. This arbitrage always exists. Uh, just to recharge your thought process, just to trigger your imagination. What is the difference between pending orders and volume? Think and answer, please. What is the difference between pending orders and volume? Vikram made an amazing statement. I love it. He said, sir, volume has already happened. Pending order is not yet happened. That is the right statement. That is what I want. Volume is orders that are executed. Pending order is orders that are pending. So, can I say volume is the game, the war which has already been fought? Pending orders is a game that is yet to be fought. Can someone make a statement? I repeat, volume is already past. Volume is the past battle. Pending order is a battle that is ahead. Great. Okay. That's a very, very important thing. Remember that. Very nice. Now, essentially, volume profile takes total volume traded at a specific price level during a specific time and divides the total volume into buy volume or sell volume and makes an information visible for the trader. So we have been talking that we are price action traders, we act on levels. So we don't trade at certain levels. We only wait for a specific level. And that specific level is where you wait for your trade, and hence you are a tiger and not a cheetah. Here, volume profile is all about different levels of volume behavior, which will give you better insight on the price and volume conjunction, or I can say even confluence. Is that the right term, friends? Price and volume confluence. What kind of a candle is this, friends? It's an ERC candle. Thank you. Someone says NRC. Sir, it doesn't look like an NRC for me. Sanjay sir, it is an ERC. It is an ERC base. That is a complete answer. Thank you, Krishna and Dibyakant. It is an ERC base. Okay, who is under control? Technically, buyers are under control because the price closed at the top. If you say nobody because of the base formation, please remember where the price closed. The price closed exactly on the top. I would say top 25% of the entire range. So buyers are in control. Can everyone accept that? All right. Now, that is the price. Now, when you look at the candlestick, did you know that the price first forms a low and then a high? Did anybody knew it? When you saw the candlestick, you know. You never knew it. If you want to know it, what is that you have to do? You have to go for a lower time frame analysis. Now, the same candle has been redefined with a range with clear definition of volumes at each level. What was the volume at every price level? So which means this is bisection. How many of you did bisection in college? If you are a science student, you would have bisected a cockroach, or your teacher would have bisected a frog. The entire price in the candlestick is completely bisected in order to identify the locations of maximum transaction, maximum volume. Now, where is the location in the candle where maximum volume happened? 43,000. Is it not the location? Now that works out this location. So this is the place in the candlestick where maximum volume happened. All right. Let's move further. What is the difference between a traditional volume versus a volume profile? What does your traditional volume say? You have a price chart and you have a volume chart which comes below with your volume in y-axis and time in x-axis. At each time interval, it will tell you the total volume transacted. Correct? But friends, do you understand? This volume can be a cheater. You know why volume is a cheater? If you all remember, let us say I am a medium sized institution. Tomorrow morning, I want 750 lots of Reliance to be purchased. Okay, if by any chance during the day, if I buy Reliance at, let's say, at 1 p.m. and I punch a market order of 750 lots, suddenly there will be a spike in volume during the day. Is it right? Now, instead of that, why should I tell you that I am buying 750 lots of Reliance to you? Instead of that, I will tell my team members, do one thing. There are almost 375 minutes in a day. So I tell my team, don't waste your time. Just put an execution algorithm which buys 2 lots every minute at whichever price it offers. Everyone agree? Instead of buying the whole price at a so-called lower level, okay, one shot 750 lots, I will tell my team members directly buy 2 lots every minute. 2 lots every minute. So how many lots over in a day? 375 minutes of trading. Everyone agree? So when the institution decides to buy like that based on time-based execution, there is no way your volume chart will tell you the total accumulation the institution made. Everyone agree? Give me a check. Now, even if the institution has cheated you, let's say the institution is smart, the institution decides don't buy one shot bulk, everybody will come to know that. Instead, buy this execution algorithm. However, when you get a volume profile, you will know where, at which price level maximum volume was transacted. Okay, and who defines this particular level where maximum volume gets transacted? An institution can even define. An institution can say, I want to buy maximum number of these shares at 210 rupees. I can do that. However, the war between the buyers and sellers defines the total volume. Now, what is the point here? The point here is, if you look at the entire price behavior in this chart, this volume information, which tells you the price and volume confluence, where maximum volume is getting transacted. Here, you just get volume. You don't know. For example, if you take this candle, you only know this was a time where maximum volumes came and the price rallied from A to B. But volume profile clearly says, boss, this is the price maximum transaction happened. So which is more clear and more specific. Pankaj says, sir, is it similar to open interest at particular strike price? No. It's entirely different. Now, let's see the anatomy of volume profile. Here is a beautiful candlestick chart with a prospective anatomy with its components clearly described. So let us try to deep dive on these concepts one by one. The first and foremost thing in a volume profile is something called as the point of control. The point of control is a level, is a price level where maximum volumes got transacted. Everyone agree? POC, we call it POC. The point of contact in the volume profile is a level. I'm sorry, point of contact, point of control is a level where maximum volume got transacted, which is very interesting and important information. Okay, then there are two more levels which are called as value area high and third one value area low. These two are the regions within the profile or within the entire candlestick in the day where maximum volumes got transacted. The maximum volume got transacted today in this particular range, which means how many of you know in Pareto analysis we say 25% people generated 75% revenue. The 80-20 formula. Thank you, Rahul. Okay, what does that 80-20 formula say? It said 80% of the problems are created by 20% of the customers, or 80% of the revenue is given by 20% of the customer, and this rule book is always valid. Similarly, in a volume profile, The value area is an area where more than 70% of the total volume is transacted, and the top and bottom of the value area is defined, and they are called as value area high and value area low. So in a volume profile, you have the point of control where maximum volume happened, the value area high where the upper side of the 70% volume happened, and value area low where the lower side of the 70% volume that happened. Now, keeping these conversations aside, can you notice this big volume regions price where maximum volume got transacted? Everyone notice that? I marked all of them in blue. At the same time, there are these small regions where the volume transacted is very low. And all these locations or the price levels where more volume is generated is called as a high volume node, and locations where low volume is generated is called as a low volume node. Clear? Any questions so far in the anatomy? Give me a check. Shall I move on to the next one? Sir, is point of control area of maximum volume transit in that particular day? Absolutely, in that particular day. It's always for that day. You can even do it for that month, you can do it for that week, you can go, but it is whatever you see it for that day. Okay, Rahul says explain value area high and low once again. We will do that. We will do that. Now this is Nifty 5-minute chart. Let me take even Bank Nifty. Okay, this is a volume profile of Bank Nifty yesterday last 5 minutes. Okay, Friday last 5 minutes. Now this is the point where maximum volume got generated. This yellow line is called as POC. Is that clear? Okay, yes. Now this is the region, the top of the region. This is the bottom of the region. This is your value area high. This is your value area low. This is Bank Nifty futures chart, Bank Nifty index chart. You will not get anything. Sudeep is telling Ashok, is this Bank Nifty futures or just index? How many of you know there is no volume profile for index? For Nifty spot, there is no volume profile. Why? Rajan says because there is no trading, it is not tradable. Absolutely. So which means you will never get a volume profile chart for index spot price. Okay, thank you. Okay, okay, that is one part. The entire bluish region that you see, okay, that you see is the value area high and low, and this is automatically created by the program, and the program manages wherever maximum volumes get transacted, it will create the profile. This is system generated. All right, now there is one interesting thing you should know. These two are that we will discuss later. For now, all that you should know is that is the value area high and value area low. Now let me do one thing. Let me minimize this chart. Now can someone explain me what is this line A, what is this line B, and what is this line C? C is POC. Okay, thank you. C is POC. So POC of what? So it is the POC of previous day. So it is previous day value area high and previous day value area low. Okay, and this is something that the AFL is smart enough to redefine on itself. So you don't have to worry too much about it. All right. So that's about it. And generally, the profile picks up the topmost, the best 70% of the region where maximum trading happened, and mark that as value area high and value area low. Okay, everything is taken care by the AFL. You just need to observe, and this will be a part of your Super Studio. Got it? This AMI broker troubles on Sundays. All right, let's go back. So point of control is the price level of the time period with the highest traded volume. Will you know? Okay, now let me ask you a simple question. Now point of control is a level where maximum volume got traded. Will point of control tell you at what time it got traded? No, it will never tell you. Profile high, the highest level the price reached is profile high. What is profile high? Nothing but the high of the candle or high of the day. Profile low is the low of the day. Value area, the range where 70%, okay, of the volume is traded, that is called as volume. Now if you ask me, Ashok, why 70%? That is what in even Jim Dalton uses in his market profile theory. 70% is a universal language. You can use 75, you can use 80, that is your choice, no problem, nobody stops you. So that is an area where 70% of the volume gets traded. Now I have a setting, I have a parameter, I can make value area as 80. Did you notice? How many of you are noticing that part? Watch the volume profile chart on my left. See, I am reducing the volume. Automatically the profile is changing now. Okay. So I keep it at 70. That is what I set it at. And value area high is the highest price level within the value area, and value area low is the lowest price level within the value area. So you should know this much for now. Now the price level in the volume profile where the volume transacted is highest is called as the point of control. So where is the point of control of yesterday's close? It is here, 23,560 is close price. Maybe 23,580 is point of control, which means yesterday the price is completely balanced. Where was yesterday's point of control? It is there in the system if you observe properly. 23,913 is yesterday's point of control. And where is yesterday's value area high and value area low? So observe carefully. This is yesterday's value area high, yesterday value area high. This is yesterday value area low. This is yesterday's POC. See, this is carried over here as a dotted line, and this is carried over here as a dotted line. What is this yellow line? This is today's POC. This is today's value area high. This is today's value area low. Okay. Now let me ask a simple question. What is this line? What is X and Y? Okay. Nobody knows what are those lines. We'll discuss that in the subsequent slides because I have not yet explained them. Okay. Anyway, now high volume nodes are peaks in volume at or around a price level. The high volume node can act as an indicator of price consolidation. Usually there is a great activity on both buy and sell sides, and market stays at that price level for a long time. Now tell me something. From a price action perspective, where is the place where maximum volumes get transacted? Nilesh says war zone. Babak says base. Ram says consolidation. Excellent. So the zone is a place where maximum war is happening, and that is where we need to look for our manipulations. This can imply fair value of the asset. When price approaches a previous high value node, high volume node, okay, a sustained period of sideways movement is accepted or expected because that is a place where there is a proper tug of war between the buyers and sellers. Price will take some time to break through either on the upper side or on the lower side. What does that mean? These are the regions where maximum volume is traded. And these are the regions where volume is less traded. Ram says, sir, can I be an option seller there? You can be, sir. You can give a try. Which means they are the zones of actions. They are the zones of actions. Okay. That's where the price majority of the times fights. Okay. And from such regions, all manipulations happens and price reacts from that zone generally aggressively. See, the high volume zones, the high volume levels or the volume profile levels acts as many times support and resistances. Praveen sir says, Ashok, can I take a POC as a PRG? Not always. Not exactly. Probably you can conclude at the end of the day. This is for a 1 day interval. Okay. See, you can draw volume profile for a day, for a week, for a month also. We'll show it. So high volume nodes represent price zones where heavy trading happens naturally. And these prices are accepted by market participants. Buyers are happy to buy, sellers are happy to sell. They are nothing but a good zone in terms of price action. That's what you need to tell your mind. Yes, Manish. And what is more important is once price move out of these high volume nodes, they are likely to act as support and resistances because that's where excess buyer and seller behavior is. So whenever price comes back into those levels, these nodes acts as magnetism to the price, which means it will revolt, it will react. The price will react from those levels. On the upside, it will take support. On the downside, it will take resistance. And there are so many high volume nodes in the price, in the price journey. So we need to understand which one is good. That is why we believe in price volume confluence in this particular learning today. Okay. So price is likely to react from these high volume zones and you can plan your accordingly. But now which high volume node you want to trade? That is a $1,000,000 question which we are trying to introspect today. Low volume nodes are opposite. They are levels of significant drops or significant rallies. Now, as a price action trader, where will you find low volume? You will find low volume in a, okay, I got the answer. I find maximum low volume at the momentum levels. Rahul gave me the right answer. at the momentum candles, your zones are high volume nodes, whereas away from the zone, the momentum candles, the rectangles are the low volume nodes generally. Not even the wicks, not even the wicks, because wicks are the source of action. Why? Because wicks are the regions where manipulations happen. When price approaches a previous low value or a low volume node, which is an unfair area, the market is more likely to rally through or bounce off. Most of the times it will cut through it, because the price doesn't want to spend much time there, because from a price action perspective there is no warriors. How many of you understand? Take the fort example in price action. In a fort, the zone is a fort. In a fort, there are warriors waiting to fight. But in between two zones, there is one region, no? There you will not see warriors. Everyone understood this point? I think I need to draw this. This is very important. Now tell me something. What is A and B? They are proper zones. What is this region? That is the region which you are not interested in. Why? There are nobody to fight there. There are no warriors to fight or to defend or fight off. There are nobody to push the enemies back or pull their army down, because that is a region of less volume. Either the buyers will pass through or the sellers will pass through downwards. Understand? It's like a highway after the signal. It is like a highway after the toll, highway after a hump. So whenever price goes through the low volume nodes, it will just break it, because that is the region where it is not strong, where there is no need for understanding between buyers and sellers. It is just an area of domination. Price will break through it. Okay. Now let us talk about the value area high and low. The top and bottom 70% area where maximum volume is traded. Now in the example in the previous screen, I had clearly shown how to set the value area high and low. The universal standard is 70%, so we have picked up 70%, and the default setting of my system is also 70%. You can use that itself for your learnings. Okay, and anything between the value area high and value area low are the level of actions. Now let me ask a simple question. Friends, what is this? And what is this? That is day size and the days low. You can also call it as profile high and low. Okay. Okay. There is a interesting question. Joy says, why does price break if the volume is low? It's like asking, sir, why is the car going at a very high speed when there is no hump? Joy? Joy is asking, why does price break if there is low volume? So my question to you, Joy, again is, why is the car going at a high speed when there is no hump? You got it, Joy? There's nobody to stop you. So naturally you will go faster. You will move ahead. The next important aspect is a virgin POC. You can also call it as fresh POC in your price action language. The POC of the past is called a virgin POC until the price breaks that level. What do you mean by that? Any guess? A virgin POC is a fresh POC level after the creation that the price has never gone back again. Now look at this beautiful example. Watch carefully. Now, this is your value area high. This is your value area low. Where is your POC? Here is your POC. Can you get this? This blue line, yellow line, sorry. Now, this POC was created by end of day here. Next day, what happened? Price opened gap up and price rallied up. Correct? It rallied up, it came down, went up, came down, went up, came down, went up, and finally at one point of time, it touched here. Okay? Do you guys notice immediately after this region is touched, this line became a dotted line? Everyone notice? Everyone understand this? It's a virgin POC until the price comes and touches that point. If price touches that point, the virgin POC will become a normal POC, and that is why you see a dotted line. All the dotted line in POC is normal POC, yes. All the dotted yellow lines are normal POC. All the, what does this mean? Can you notice this? What is this? Can someone explain me? It is a virgin POC of the previous day. At that price point, when the moment price touched, the virgin POC got tested and then it became a normal POC, and that's why the yellow line starts. Is this a good work? See how much of activities it is doing. It's helping us. Sounds good. So this is something which the AFL does. So you don't have to worry. Okay, this particular program will take care of it. You can watch it, or else you need to go behind. If you use a normal volume profile indicator in different charting softwares, if it is not coded, you need to go back and watch. At least here you will automatically come to know which POC is virgin, which is not. So that is one good thing. So coming to the summary of learning so far, volume profile tells you what is the volume that has been traded at every level in the price. And high volume nodes are places where maximum price acceptance happen, maximum fight between the buyers and sellers happen. It is as good as a zone for a price action trader. And low volume nodes are places which tends to break quickly, which gets passed through. It's a very negligible barricade. And POC is the place of the highest volume transacted and critical aspect in volume profile trading. Can we say that POC is the highest HVN? How many of you agree? Your POC, the point of control, is the highest HVN. Yes, that is the point. Good. And a virgin POC is always a lot more powerful. So there's a question by Sarvana. He says, can we get a POC in this volume profile FL? What do you mean by PPOC, Sarvanan? I don't get your question. VWAP can also be a tool used for price negotiation. How many of you observe that there is one more yellow line here? Did anybody notice? See this line? That line is nothing but the volume weighted average price. Rudra says, is volume profile similar to market profile? Yes, it is similar to market profile, because market profile is about how many times the price touched a particular levels. I repeat, market profiles tells you how many times a particular price level is transacted. Market profile is all about this. Let's say this Nifty is 10,000. Okay, Nifty 10,000. So today price went up. First time it broke. Second time, third time, fourth time, 5 times, 6 times. Understood? 1, 2, 3, 4, 5, 6 times price tested or price crossed a particular level. That's what market profile tells you. Somebody says, sir, can I change the colors and other things? Friends, you can do all of that in the parameter settings. I don't want to go into the parameters to explain the micro stuffs. You can play around with it later once I give you the AFL. Okay? Sounds good. With this, we come to the end of the introduction session to volume profile. Let's get into the Q&A mode and then get assembled again for the advanced conversations of the volume profile. Is it available in TradingView? Yes, it is available in TradingView. It is very much available in TradingView. I think it is paid. Of course, it is paid. It could be paid service. I think I am able to generate because I'm a paid user of TradingView. See, if you go to basic version, I don't think he'll give you. Where is volume profile? Yeah, it's not given. For pro version, it is given, which is around $150 per year. Okay, yeah. If you okay, Babak sir is telling if anybody wants to sign up, you need to wait for Thanksgiving because they give very good discounts that time. Okay, so you want indicators, volume profile, visible range. See here you go. Okay, so it exists. So Hiral says on Black Friday it gives some 50-60% discount. Go and grab it that time. So Nilesh says, can future and cash has same POC nearly more or less? Okay, and Ramki says, are there any good books on volume profile? Very few. I think I bought one book. Not many good books on volume profile. Honestly, not many. I said one of us should write a good book on volume profile. Is it possible to write volume profile on option charts? I am not sure. We need to check. We need to check. Okay. We need to check. I think you can write option. It's possible because ultimately the volume transacted at a particular level of the price, no? So if you treat your option as a script, it does. Yes, Anu, that's what we are trying hard to find out. Okay. Decisions in your trading stuffs. So friends, the next two subjects or the next two chapters or the sessions I have structured in such a way that this current session number 2 will mainly focus on volume profile in isolation, and the next session post lunch we will see volume profile in confluence with price action trading. Okay, so that is my biggest key point or the value proposition that would offer from volume profile perspective. So in this current session we will talk about other advanced elements, and also you can even look at trading on volume profile as a standalone application without the entry or without the addition of any price action techniques. That is your independent choice, but myself as a trader, I know price action tells more about price. This volume profile tells more about volume. When I bring them together, the confluence will give me a respectable edge. So I prefer it in that mode, which means I always want to trade using price action only, but volume profile is a confirmation tool, something like WDGAN, which is our time confirmation tool. Okay, but I will never believe in using it in isolation, nor I have ever done it. However, since it is a full day extended volume profile program, I have utilized the time to give you insights about the thought process so that it gives imagination. Okay, it gives food for your brain, food for your imagination. So if you want, you can always use it in your own way. There are so many of our own participants who uses GAN dynamic square of 9 in isolation. That is their choice. Okay, but this is how I wish to think and look forward to. All right, now let's move on. A quick disclaimer. So let's talk about the advanced building blocks of volume profile. The friends, the first and VWAP. I did mention about VWAP in the initial session. If you remember, this yellow line that you see, okay, this yellow line basically acts as a indicator. Okay, this acts as an indicator, predominantly giving you an input in terms of where the price is trending. Generally, how does your moving average work? Whenever price crosses your moving average, we think it is bullish. If it goes from down to up, or if the price crosses your moving average from upside to downsides, you will say it is bearish and you will take your own entry. Of course, we don't trade moving average, but that is the underlying principle with which people trade moving averages. If there's anybody who are trading with moving average, it is best for them to trade with VWAP, the volume weighted average price. So what is VWAP? Anybody? What do you mean by VWAP? It is the average of volume and price combination. Each price is weighted by corresponding volume. That is the best statement one can make. I repeat, each volume is weighted by corresponding volume. Thank you, Babak sir. Here, friends, in simple moving average, let's say you have 5 samples. Okay, let's say there are 5 people in the class with different heights, 5'10", 5'8", 5'12", 5'10", and 5'9", and 5'11". Now what happens when you take an average of the 5? What you'll do, you'll add up everything and divide it by the number of people. That is your simple moving average. So if it is exponential, what you will give? You'll give more weight to the recent volume weighted average is volume, and the whole thing is divided by the volume itself in order to arrive at the average price. Clear? So the net is there. Net is there. I lost audio just once right now. So cross check once. It has come out. Is it clear now? Okay, can everyone give me a check? Yeah. Okay, so VWAP is fundamentally the volume weighted average price. At every price level, you multiply the total volume transacted there, and then the total thing, the overall volume is divided. Okay, so that will give you the VWAP price, and this VWAP will also give you a sense of direction. Okay, there are so many traders, intraday traders, they use VWAP as a confirmation tool for their trade. You can also use this It has been inbuilt in the indicator itself. So the next important thing you need to know is about the shapes of the profile. Every profile will comes with a story. Okay, the shapes of different profiles are important, not only mainly from a positional perspective, but also it gives a useful hints on an intraday perspective. And every shape will convey a meaning. Can you see this? And look at this shape. Can you make out? Every shape is different. Every shape conveys a different meaning. So let us try to understand these shapes before we even get into the trading world. Okay. The first and foremost shape is called as a D shape. And uniformly distributed bell curve, you call it as a D shape. Can you make out? So what does this D shape bell curve tell us? The profile looks like the letter D. It says that there is a clear balance between buyers and sellers. There is an harmony between buyers and sellers. It also indicates that there is a massive transaction and the big players are getting ready for a big move. So whenever you see a D shape, it means that everything is in balance, but there is a possibility of a big move. That's what your D shape tells you. Now, if it is a big move, which direction? That you need to understand. Understood? So that is the summary of D shape. You should know that every transaction is in harmony. Okay. D shape tells there is extensive transaction that has happened. And the third thing is the price is looking forward for a big move. That you need to know. And based on power patterns, you can identify the right locations to think about your trading. The second shape is called as a P shape. What is a P shape? Can you notice the letter P there? So what is your observation there? Can you notice the entire value area is on the upper half of the entire profile? Everyone agree, friends? Okay. So what I'm trying to say here is, if you look at the shape, yes, it looks like P shape, but the fact of the matter is, the crux of the matter is, you must know that the complete value area, your value area high and value area low, are on the extreme upper side of the entire profile. That is what is important.
See, your P is almost covering your value area. Can you notice? Can you give me a check if you notice that? That is the important observation from a structure perspective you need to make. At the same time, you must know certain things. Number one, the profile looks like letter P. Yes, the structure itself conveys that message to us. This shows the domination of buyers who are in full control. Correct? If the profile is moving towards upside, and if the point, where is the point of control? Anybody notice where the point of control is? It is here. In the top quartile. Thank you, Rahul. That is where your point of control lies. Venki says, Ashok, POC is biased. It is biased towards upside. Multiple P shapes denotes an uptrend. What it means is, if profile makes multiple P's like this, it means the overall trend on the higher time frame is up. Clear? What about this? It means there is a D-shaped curve. There is a range bound distribution that is happening. If you find a P after a good fall, it is the end of the trend. How many of you get this statement? If you find a P shape of a profile after a solid fall, it is the end of the prospective trend. It is a beginning of a prospective new trend or a time to consolidate. Now, the third shape is called as a B shape. Can you notice the shape there? Okay, so what is the observation? Your value area is on the lower side of the entire profile, which is exactly opposite to your P. How many of you get that? This is exactly opposite to your P. Here, the profile looks like letter B. This shows clear domination of sellers because sellers have pushed the price down initially. Multiple B shapes denote downtrend. Something like this. Multiple B shapes denote downtrend. And finally, if it's a P, what does that signify? It signifies reversal. If you find a B after a very good rally, then it is the end of the trend. So technically, there are only three shapes: the D, the B, and the P. The D is harmony, the P is buyers in control, the B is sellers in control. And there's one more interesting shape called as the slim shape, which is the fourth shape. We have the shape of an uptrend, we have the shape of a downtrend, we have the shape of the balance, and we need the shape for imbalance, right? D is all about balance. So how does this profile look? Look at this. Did I manage to write a human face? It looks like a robot. Okay. Okay. This is just a haphazard profile where there is no clarity either in the trend or the harmony. Can you all notice? Can you all notice that there are very few high volume nodes here? How many of you notice? More of low volume nodes than high volume nodes. What does this signify? It's either signifies free fall or a free move. Less liquidity. This kind of profiles does not have a clear shape. Markets gets one-sided. Always remember, friends. What do you mean by one-sided? What is this? It's a proper trending. What is this? This is one-sided. Okay. Extensive stretching of a trend, which is dangerous. There shall be fast movement. Okay. That is about the slim shape. Now looking at the chart, what kind of a day is this? Who controls this day? It's a P. How about this? How about this? Okay. So keep an eye on the profile shapes. Now, let us get into the next crux of the whole behavior. We discussed 5 general profile behaviors in this session. Okay. Now, friends, these 5 general profile behaviors are with respect to relativity to the price and volume profile. Here is behavior number 1. What happens when price opens above yesterday's value area high? Whenever your today's price opens above yesterday value area high, can you see the red button here? Okay, the price opened there. So what this behavior says is, the moment price opens above yesterday's value area high, but still it is well below the profile high, then statistically the price will retrace towards the point of control, and then it look forward for a rise. Therefore, whenever price tends to retrace towards the point of control, you can think about a trade. Let's say price opened here. So what happened price to price? Price opened between the profile high and the value area high, and price is trading between the two. And finally, at one point of time, the price comes and touches the point of control. In such a situation, the price finds harmony at point of control, and it can tend to react from there, and that can give you a prospective trade. This is price behavior 1. Whenever price opens above yesterday's value area high. Okay, why price opens above and why it has to come to POC? It has to come to POC because POC is the level where there is an acceptance in price between the buyers and sellers. Everyone agree? Any questions here? So your POC is a war zone, your POC is a high liquid zone. Price can tend to come there and then react from there. Now, let me ask a simple question. Is this an intraday prospective trade or positional trade? It's a pure intraday because purely you're acting based on yesterday's price behavior. Okay. And Dibyakan says, but sir, there is also a possibility it may not retrace to. Yes, very much. That is why we have stop loss. And we all believe only in stop loss. Okay. And next price behavior is when price opens below yesterday's value area low. Which is the statistically accepted behavior is that whenever price opens below yesterday's value area low, the price tend to go to POC looking for liquidity, and it can make a good reversal from the point of control. Okay, so the price tends to go up, finds more liquidity at the point of control, and from there it tries to fall down. Therefore, during this retracement from the point of control, there is a shorting opportunity. There is a question, does it mean it's a gap down? Gap down, it can be anything. It need not be gap down. Okay, and the next behavior is whenever price open above the high and low of the profile. What does this ideally mean? It means price has opened above yesterday's high and low, right? It has clearly opened above the high of yesterday or below the low of yesterday. There is a clear imbalance. Whenever such a scenario happens, when price opens above the profile high, it can try to trend higher. Whenever it tries to open profile low, it tries to trend. Okay, it can be a possible runner in the direction of the opening price. Your 5-minute breakout, your 15-minute breakout is all based on this principle only, because the principle of imbalance. And the next interesting scenario is when price opens below previous day POC. That is the POC of the previous day. Okay, we always look at the first 5 minutes or 15 minutes breakout, and whenever the high and low are broken, okay, once it breaks the high, it is expected to go and kiss the POC. Your POC becomes your target. Okay, if price opens below a previous day POC and breaks out with the high and low. Any confusion here? So what are we telling? I'm not telling you to take a trade. If you are looking for a breakout kind of a strategy, if the POC can be the best place for target. If the price opens below previous day POC and if that POC is a virgin POC. So this is for either your 915 to 920 or 915 to 930 scenarios. And what if the price opens above your previous day POC? Then take the same high-low breakout of 5 to 15 minutes. If it breaks out on the lower side, expect the price to come and kiss the POC. So a virgin POC is a gravitational attraction. Price gets sucked towards it. And hence you can look forward for such a trading opportunity. Now let us go to the chart. So let us watch how price moves. I will go to last, where are we now? We are in October 18th, right? We'll start from Monday the 12th, from Monday. I'll take a 5 minutes chart with 5 period intervals and start a replay. Okay, I have rewinded the entire chart to Monday, last Monday, which is the 12th of 12th of October 2020, and now it's running. Now, when you look at it, friends, which are the points of observation now? How many of you agree? What is this? It's a VPOC. It's a virgin POC. Number one. Number two, this is the value area high of yesterday, value area low of yesterday. And here is the current POC of the day, the realizing POC of today. And if price comes down, we need to see how price behaves. Let us watch the price behavior. Can you see price came and kissed the previous value area high and it reacted? It came, okay, it kissed, it formed a bull candle and went up. Now it broke that particular value area high once again. Now, does it come to POC? Let us see. It came down to the POC level. Okay. And there is a zone there at the POC level. Can someone make out that zone? It reacted from the POC level, and let's see if it comes to the value area low of the day. The price opened next day. The price opened next day. Okay, at the roughly at the below the yesterday's POC, and it came towards the value area low. From there it reacted. It went ahead and broke the yesterday's virgin POC also. Can you notice during the whole journey at the price, at those important points, the price is consolidating? How many of you get that? That is the points of change in dominance. See, that is today's POC, and you have yesterday's point of control. And I forgot to tell you one thing. These two lines are called as initial balance. We call it IB. IB1, IB2. It is nothing but the first two 30-minute candles, high and low. Everyone agree? Which is the first 1 hour candle? The first hour of the trading day. Iska high low. Okay, so what we are trying to convey is, when you observe the profile charts, when you observe the entire profile chart, it is clearly telling you where are the major volume concentrations are, at what price. That should give you a respectable indication of what you need to do. See, all you need to do is to identify the volume pockets, and you are anyway working on price action power patterns. So from price perspective, you know the levels very well. And now all that you need to do is to just find the confluence of both price and volume and identify that as a central point for your next trading decision. Got it? So I will share this, we'll ask Rashmi to help you with all the volume profile AFL also. So this week, next week, I will try to build the revised DLL document for the Super Studio of AMI Broker, or else I will, by that time, you should have this AFL with every one of you. Okay. So just give me 1 week time. By next weekend, I will try to give this AFL inbuilt with the Super Studio. And I will also add this one more thing that I need to add with respect to profiles. There are two aspects that I need to address, and I need to implement that in the AMI Broker DLL and share it with everyone. Okay. So now, friends, you can use volume profile in isolation as an independent trading tool without price action also, all intraday players, because it will clearly show you where are all the imbalances are, what are the kind of shapes that is getting generated, where the price is consolidating with your normal price behavior zones, normal price structures also. You can think about trying. That is your choice. So no problem. Okay, but I strongly believe in the confluence of price action and volume, which I will teach you in the next session. So coming to the summary of the conversation, VWAP is another indicator which sometimes helps in deciding your trend. It's just like crossing up and up below, like your moving average. The different volume shapes gives clarity in the direction of the overall trend, mainly in your positional picks. Never forget the importance of the profile shapes. Also remember the 5 behavioral rules of volume profile. And if you can try to play around with the behavioral rules and see if you can get an edge. Okay, you can even use the volume weighted average price as a confirmation tool. But if you try to do things, too many things at a very lower time frame, it's going to be difficult. Mind you, will not have much time to study and analyze. Remember that part. With this, we come to the end of the advanced concepts in in the volume profile. And in the next session, we will see the integration of price action, of price and volume of the volume profile together, and see how it can give us a respectable edge. Because that is what is going to be a proper confirmation utility as far as volume profile is concerned. Any question on my screen, session number 3? Yes, thank you very much. So we'll start now. Sharp 2:10. Will not waste any more time. I will start the recording. Sounds good. Recording started. Good afternoon, friends. Welcome one and all to the third and final session of the volume profile trading module as a part of i3 T3 Mega webinar. So we are in the last session of the day titled the volume profiled price action trading. Now friends, in the first two sessions, we successfully learned about the basic building blocks of volume profile, followed by the advanced blocks, the volume profile shapes, the different behaviors of volume profile, and so on. In this session, we will try to bring the intelligence of price action along with the intricacies of volume together in order to find some confluence between the two. Before we move on, a quick disclaimer. Sounds good. Now let's see the volume profile price action trading, where we try to merge price and volume together and identified sweet spots. So let's go with Nifty first. So let's go with Nifty 5 minutes chart, and I'll go with Nifty 5-minute chart. Okay, now talk about price action, friends. This was the yesterday's close. What was the yesterday's close of Nifty? 11,768.5. Correct? Now, can someone tell me, how do you look forward? What is the first thing you look forward for price action? How do you identify your power patterns? What is the first thing you look for? Thank you, Santosh. The answer is engulf. You need to first look for engulf. Wherever there is an engulf, then only there is a prospective power pattern. Now let me ask you a simple thing. Is this bottom low engulfed? Is this engulfed? Number 2. Number 3 engulfed. Number 4. Number 5. Number 6. Number 7. Number 8. Number 9, number 10. These are the SR levels. Okay, I'm just going reverse direction and marking all the possible SRs. Now, how many engulfs you know according to the chart? Can you please watch it and let me know? Eight is an engulf. Thank you. What else? Divyakan says 8 is a flag. 10 is a cap. Okay, brilliant. Divyakan says 10 is a cap. 12 is engulf. Thank you. Okay. Which is the first engulf if you go reverse? Amit Chavan gave me an answer. Vikram gave me an answer. Which is the first engulf? The first engulf according to me is 7. Any arguments? Yes, I mean, in terms of levels, because see, 4 is an engulf. 4 cannot be treated as an engulf because it is close above. Yes, you are right. It didn't give any power pattern. Yes, I am sorry. I give marks to Rahul, Lokesh, Manish, Amit, everybody. Yeah, 4 is certainly an engulf, but just that it's an engulf. Now, I remove everything. The most sensible engulf I know is this. Okay, that is a good engulf. Friends, what is this? Okay, everyone convinced? It's an authentic zone, it is a fresh zone, it is an FTR. Thank you. The next engulf is this. Do you guys know that FTR is already tested? The topmost FTR is already tested. The trade is over. The second bottommost FTR is pending. Now, I'll ask you a next question. What about this SR line? SR line 3. That's a flag limit. I cannot call that as an FTR. That's an FTR. What is this, friends? Okay, great. So we found our levels. Okay, this is what? 16th October, last Friday. Chart of Nifty on a intraday 5-minute time frame. Is there anything that you have observed? What is this whole thing? It is absolute compression. It is compression. So which means, what is the enemy for India? Is it Kenya or Australia? The enemy is Kenya. Thank you. Now, good enough observation. Okay, now how many of you will take a trade here at this flag limit? Now the price is 11,768. Tomorrow, when the trade moves up, okay, I think we can try this FTR. Why? It's a good level over level. Okay. Okay, all right. So people are telling the flag limit is not a good trade. FTR is better because of LOL. Superb. Sounds good. Now, let us introspect the same scenario in with superimposition of volume profile. Now you have done all the price analysis. Now let's move on to volume profile. Now, which is the FTR you wish to trade? 11,860 to 11,840, which means this one. Now, what is your observation now? This is a price based FTR which you have identified. And you told that this particular flag limit is not a good idea. This was our price action observation. Now please throw your comments. Take a minute, observe carefully from a volume perspective and throw your comments. Okay, now if you look at the price chart, let me take a pink color so that there are so many yellows and blues. Okay, so far this is the point of control of the POC of the current candle. Okay, this is the value area high, this is the value area low, and then this is the POC of yesterday, YPOC, yesterday's value area low and yesterday's value area high. Okay, now friends, according to me, this is not the YPOC of this one. I think it is much before. How many of you agree? POC is the longest yellow line, right? But this damn guy is lesser, no? This guy's POC is this. This is yesterday's POC. This is yesterday probably. Everyone agree? It is a older POC. It is a older POC and it's not yesterday's. It is probably day before yesterday's. Let me check. I don't know. Yeah, it is day before yesterday's POC. All right. Now that is a location and that is the price. What happened? That is a point of maximum volume. And such a maximum volume location has been broken from the upside, which means who is dominating that position? The point of control location was dominated by sellers. Now your FTR as per price action is dominated by sellers. Can I consider this as a confluence, a beautiful confluence of FTR along with volume profile, virgin point of control which is broken? Okay, now the flag limit we don't want to trade. Now do you also observe that flag limit that you see is also day before yesterday's value area low? The flag limit that you see is in confluence with day before yesterday's value area low. Now since we strongly believe in level over level, we will ignore. Tomorrow we will see if we can take a trade at FTR. What is the risk here, friends? 15 points risk, around 1250. That is a risk for this trade. 15 points of Nifty. How many of you understood this? Okay. Okay, please repeat. Friends, we identify a good FTR, which is a fresh FTR, which is an authentic FTR, untested FTR. And we also found that FTR level was a previous point of control, which remained a virgin point of control for 2 days. And finally, that FTR broke that point of control, which means there were big volumes. There was an harmony between the sellers and buyers. At that point, it was broken by sellers. So this FTR seems to be good place to take a trade. Okay, not only that, you see brutal compression below. Okay, and also some people are saying, sir, this can also be an FTR, sir. This can also be an FTR, because if you take this as the stoppage and this is your L2 and this becomes your L1, therefore this is an FTR. Okay, no worries. But the point is, the price spent a lot of time there. There is no sense of urgency of FTR, and not only that, there is sufficient gap between this level and this level. There is gap. There is a strong momentum candle here, and that momentum candle is not ordinary. It is as good as high was 889, low was 850. So almost 40 points gap is there. Okay, and not only that, the entire formation is bullish. The shape, uh, if you look at the whole shape, 75% of the value area appears on the top side. But don't you guys remember that it is completely spread? How many of you agree? See, the whole region is spread. It is not getting concentrated here. See, this becomes slim type. This will not become P. Okay, so is that crystal clear? Yes, that this we can say this FTR is in confluence with volume profile. All right, now let us go to the slides. So that is what we found. Now let us go to the next one, Bank Nifty. Okay, let us go to Bank Nifty. Okay, sounds good. Now tell me, is there a good engulf? Is there a good engulf? Okay, people say 23,700. I'll take a straight line. My process is very simple, friends. My process is very simple. I will go reverse and see whichever has engulfed. Okay, this guy is engulfed. This guy not engulfed. This guy not engulfed. Okay, this guy is engulfed. Can you guys notice this guy is engulfed? But did you find a power pattern? Too many bases, don't you see? This is all base, 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 base. So definitely we don't take trade there. Okay, that is gone. This is not engulfed. Now there is one damn engulf which is very interesting. That is this one. Is that a good engulf? Okay, that is the most powerful engulf you see. What is that, friends? Watch carefully and tell me. Please see close by and tell me. Excellent. Gopi, thank you. Gopi, thank you. Friends, if you find other power patterns elsewhere, kindly bear with me. I am not very keen on that right now. It is flag limit type 2, case 2, wick to wick formation. Okay. Now I'll go back in Bank Nifty 5 minutes. Where is that? I need to bring this guy is here. This is the SR line. So the wick to wick flag limit is this. So I'll mark this light red. Clear? Any argument so far? Brilliant. Amit Raj Singh says, Ashok, it's a good flag limit, but already tested. The game is over there. Yes, I agree with you. No arguments. It's a tested one. Very good. Now, let us see the same thing. Now, what does volume profile say? Please have a look. What does volume profile say? Do you know that that particular point is nothing but yesterday's value area high? Watch carefully. Watch carefully. There are two things there. Number one, it is yesterday's value area high, not yesterday's. I am sorry, it is day before yesterday's. It is day before yesterday's value area high. You want me to zoom in out? Now try it out. It is yesterday's value, day before yesterday's value area high, and there is one more thing there. There is one more aspect there. Can you see that white line? That is initial balance. There is a white line which is cutting through this white line. What is this? The high and low of the first 1 hour of the trading hours. So that line is cutting through the flag limit. That is what volume is telling you. So this price flag limit is also confluenced by the value area high of previous 2 days and yesterday's initial balance. So that's a reasonable level to take a trade, and fortunately trade also worked. If you see, in spite of a tested zone, it still worked, right? Okay, now I'm only going to look at volume profile perspective. I cannot check out other aspects. Okay, friends. So let us stick to the conversation, please. All right. Who is the next candidate? Shall I move to the next example? Clear? Can everyone give me a check if you have understood this confluence? Okay, sounds good. Now the next guy is Asian Paints. This Asian Paints. Okay. Okay, now observe this and tell me. Okay. Since it's a stock, I'm going into 15 minutes. Okay. Moving out of 5-minute zone. Now tell me your observation. Entry and exit levels not clear to Sudeep. Sudeep, your entry and exit level is nothing but your power pattern level. Your entry is proximal line, your exit is distal line. Since the previous two trades were shorts, you enter at the bottom of the rectangle, you exit at the top of the rectangle. I didn't get into all those things because you already know those aspects. I am trying to only bring the relationship between volume profile and price action. Now, what do you find? Now, go back. Okay, Sudeep is asking Ashok with respect to volume profile. There is nothing changing with respect to volume profile. All you are doing is to confirmation of the volume profile, and is volume profile supporting my decision. That's all. All right. Now, look at this. This guy got engulfed, very small SR. This is engulf missing. Okay, this engulf is done. There is no engulf anywhere. Okay. The only engulf I know is this. Proper logical engulf is this. Rest all are ordinary engulf. This is also a normal engulf. So what I will do, can you guys find this? High, low, higher, high, lower, low. Okay. Okay. Thank you. Now, technically, this becomes my zone. Okay. I've marked the whole zone. I've taken wick to body. So I'll go intraday 5 minutes and see if I can mark a better zone marking. Can I mark? I don't think so. It's a rally and drop. It is bearish engulfing at the top and a lower time frame. How many of you notice that? Should I go to 3-minute? There is something interesting here. See, I could revise. I could revise because of lower time frame. So that is a zone. Okay. On a lower time frame, I could find a fresh zone more or less. Why fresh zone? The low is 2118. The high here is 2117.7. Got very little touching. No worries. I'll go back to 15 minutes now. In a 15-minute chart, I know it is this like this. Now, if you look at it, this region is in harmony. This region is also in harmony. This is also more or less in harmony only. Correct? No unwanted stretching, no unwanted fall. Now, can you notice that this is also coinciding with previous day's value area high? So that is a region of maximum volume. I think this is a decent, it's a decent QM, Q1 attempt. VK says no, VK, it's not. VK, you got it? There is no IB there. Clear, VK? Good. Sounds good. Any other questions? Okay, this whole lesson we are looking at the confluence only. Okay, in the previous lesson we spoke about 5 different kinds of behavior. You guys go and try it out. You guys go and verify it statistically. If it gives you a good edge on an intraday, you can even try a standalone volume profile, but I don't do that. Okay, now sounds good. Now let's go to the next chart. That is Reliance on 25 minutes. Okay, so I change the time frame to 25 minutes. Okay, I just wanted to check behaviors across all time frames. Okay, this is Reliance on a 25 minutes, and this is again Reliance on 25 minutes. Now tell me, where is the first engulf? This is engulfed. This is engulfed. After that, this is engulfed. All are engulfed by a momentum candle. So I didn't find anything interesting. Next thing is this is engulfed. Okay, and the last thing is this is engulfed. Now think about it. Okay, if I zoom this in further? No. I'm like looking if there is cutting through. No. There are two momentum candles. No risk. Where is the FTR, friends? $2260. Thank you, Santosh. Now, please do observe also that this FTR is also a beautiful SR flip of the past supply level. How many of you notice it? That is why generally don't ignore the SR levels of the past. Keep an eye on them. What is the risk here? 7 points. No, it doesn't, Leelish. It doesn't. Now let's go and watch Reliance chart. $25 minutes. Okay. Let me see what this one says with base as weekly. That I will show you in the next show. All right. Now, technically, this is your zone. And do you notice that it is coinciding with the value area high of last day? Everyone agree? Where is value area high of last day? This is the value area of last day. One value area high is here. Another value area high is here. Vikram, is that clear? Okay, I'll delete that. Thank you. Now, this is based on yesterday's volume, right? Now, let me change the parameters and see the volume profile based on last week, whole week volume. What is that line? That is the point of initial balance of the whole week. It is the weekly initial balance level. Okay. Sounds good. I'll go back to daily. Now let us look at a positional trade. In weekly initial balance, time is week. The whole week, 5 days. For 5 days, one volume profile will come. Sanjay ji, for daily profile, you get one per day. If you make it weekly, you get one per week. If you make it monthly, you get one volume profile for the whole month. A big profile of the month. In fact, you can use volume profile as a standalone. You can study the behavior of volume profile across multiple time frames. I don't think anybody tried multi-time frame volume profile analysis. Anybody? But what is initial balance duration? Initial balance duration is the first hour of the day. But the point is, the first hour of the week is also same, no? How many of you understand? Rahul is asking, Ashok, the lowest volume profile is daily. Is that right? No. I can draw a volume profile at even much lower time frame. Where is 5 minute? This is volume profile of 5 minute. I'm sorry. This is volume profile of 5 minute on a daily chart. I will change parameters for hourly profile. It's throwing error. No, it only gives daily. Minimum is daily. Yeah. Anyway, who's the next guy? The next guy is, okay. Now, what happened? We can also check the volume profile of 15 minutes we checked, right? We checked 25 minutes. Correct? That's what you checked. Now try to check 15 minutes. Much lower time frame. See, the value area high is still matching the value area high. And I'll put 5 minutes also. See, that value area high is even now matching. Sensible? So this will give better visibility into your price action levels based on volume. Next. The next candidate is TCS positional. Okay. TCS positional. I'll either take 25 minutes. I can even take 75 minutes. I take 75 minutes. Now tell me. Now do reverse engineering and identify where is the angle for you to identify a respectable level. Number one is this, broken by a momentum candle. Okay. If you go back, this is broken. This is broken. Okay. Is that an SR line? What is it? Case 3. Very good. Thank you very much. Now let me go to what time frame is that? So it should be daily. I'll zoom it. Okay, theoretically, your zone is here. Now, Since you are checking on daily, I will change the param from daily to weekly. Daily parameters, weekly to monthly. Yeah, I'll take the monthly parameter. Okay. Now, this is my SR line. My SR line is exactly coinciding with the value area high. Coinciding with the value area high. What happens if I take the base as weekly? This is weekly profile. In weekly profile for a daily candle, you don't see better profiles. Or should I use a lower time frame like 75 minutes? With a daily stuff? No, it doesn't. Because they're very close to each other. So at least two parameters away we should go. So if you are doing 75 minutes, better to do weekly. Or you can even check at 25 minutes. See, now the profile looks more composed. Can you make out? This is a 25-minute chart with a weekly profile. So the zone I have marked is a previous value area high. And not only that, there is a very, very strong virgin POC supporting there. It's a value area high. 2 weeks back, value area high. And also last week's value area low. There is a lot of defense there. Lot of defense. Okay. So like this, you can bring up your price action level with a proper confluence of your zone. And by matching it, you get a better perspective. Coming to the summary, we will always trade power patterns. We will use volume profile for level confirmations. That will multiply my confidence on the trades. If both gives opposite views, I will skip the trade. Never forget the stop loss, because that is the ultimate truth which we believe. We never believe our strategy. Okay. So with this, we come to the end of the volume profile sessions for the day, and the lines are open for Q&A. Please shoot your questions. So any queries, friends? So the volume profile AFL, I will add it to the Super Studio and share it with you in a week. Okay. Just tomorrow I will initiate the conversations to inbuild this into the Super Studio, and all of you will get a new DLL files, and the DLL file will take care of everything. You get a new file from me called as i3t3.dll. Take that file, replace with the old DLL, and you will be done. and all videos would be available in Nishvit. All these videos would be available in Nishvit. So if you have not understood, go through the videos once again. Try to spend some time. Definitely you will get a fair idea and great learning. Okay. And in the future sessions, as I already told, I don't want to bring in harmonics as a topic because of its varied subjectivity. Rather, I will bring pivots. I will bring the universal pivots as a topic, because again pivots are levels, because cheetahs don't require different stories